Hi candidates, welcome to another session of manifested online classes. In this session, I want us to look on an illustration question regarding how to prepare the group accounts, whereby we have a disposal of interest. And the illustration I want us to go through reads, Pareto Limited is a holding company of a listed group of companies with its year ended on 30th of June 2021. So Pareto Limited has made a number of acquisition and a disposal of investment. So the following summarized draft statement of financial position relate to the group companies for the year which ended 30th of June 2021. So we are given the statement of financial position for three companies: Pareto, Paba, and also Dafu Limited. Non-current assets include property, plant, and equipment. Then we have investment in Paba, investment in Dafu. We have financial assets, and then we have the current assets. We have the total assets. At the equity, we have ordinary share capital, share premium, retained earnings, and then we have non-current liabilities and current liabilities. Then we have some additional information. Number one, where we are told on 1st of October 2020, Pareto Limited acquired an 80% equity interest in Paba Limited when its retained earnings stood at 3,500 million. The purchase consideration comprised of 1,250 million of Pareto Limited shares with a nominal value of shillings 1 each and a market price of 6.8 each. At the acquisition of Paba Limited, the only adjustment required for to the identifiable net asset of Paba was for land which had a carrying amount of 625 million, less than its fair value. So number two, we are told the group policy is to measure non-controlling interest at fair value. That information definitely is to guide you how to compute the goodwill. If you come across that information that the group policy is to measure NCI at fair value, it means that when computing the goodwill, we then compute that goodwill using the full goodwill method. And then you're told at the date of acquisition of Paba Limited, the non-controlling interest had a fair value of 21.25 million. Number three, Pareto Limited had acquired 100% equity interest in Dafu a number of years ago when it retained earnings amounted to 1,750 million. At acquisition, the fair value of identifiable net asset of Dafu approximated their carrying values. The purchase consideration comprised cash amounting to shillings 5,750 million. Number four, you're told Pareto Limited disposed of 60% of its investment in Dafu on 1st of April 2021 for shillings 4,700 million, when the fair value of identifiable net asset of Dafu were shillings 6,250 million. The fair value of the remaining 40% equity interest was 4,300 million at disposal. Pareto Limited has not accounted for the disposal. And then number five, you're told none of the companies had issued any shares since Pareto Limited acquired its shareholding in them. And number six, you are told neither the goodwill on acquisition of subsidiaries nor investment in associate, that is, had been impaired. So from that information, what you're required to do, number one, is we compute the goodwill arising on acquisition of the investment in the subsidiaries. Number two, to compute the gain or loss arising on disposal of the investment in Dafu as reported, Roman 1, the individual financial statement of Pareto, Roman 2, consolidated statement of profit or loss, and finally part C of that question, we are required to prepare the consolidated statement of financial position as at 30th of June 2021. So these are questions for group account, and as usual, what we need to do first of all is to come up with a group structure. Then we go through the additional information, we see whether there are workings which we need to do, and then from there we prepare, or basically we compute what is required. So therefore, let's first of all we come up with the group structure here, which will be working one, group structure, group structure. So where do we get that particular information about the group structure? So that information, we have it from the additional information number one, whereby we are told on 1st of October 2020, Pareto Limited acquired 80% equity interest in the company which is called Paba Limited on 1st of October 2020. 1st of October 2020, and also we are given the retained earnings of Paba on that date. That one will be used in the computation of goodwill, including the purchase consideration. That one will be used in the computation of goodwill. But let first of all we go to the additional information number 3, whereby we are told Paba Limited, not Paba but rather Pareto Limited had acquired 100% equity interest. 100% equity interest in the company which is called Dafu Limited a number of years ago. So in this case, we are not given the specific date of acquisition, but we are told Pareto Limited had acquired 100% shareholding in Dafu sometime back, or basically a number of years ago. So basically what that means is that from this group structure here, Pareto Limited, this will be the parent company, and automatically the parent company is the one which is supposed to prepare the group account. Then Paba is a subsidiary, and also Dafu here is a fully owned subsidiary. A fully owned means that the parent company acquired all the shares or hold all the shares in that particular subsidiary. So we have that information, but also before we go maybe back to note number 1, there is another information which is given and which is very, very important in note number 4, sorry, where we are told Pareto Limited disposed of 60% of its investment in Dafu on 1st of April 2021. So that is the information about disposal of interest. Disposal of interest. Disposal of interest, whereby we are told Pareto Limited disposed 60% shareholding in what? In Dafu. So we have disposal of interest in Dafu Limited. So, and automatically this particular disposal of interest, this usually take place during the current financial year. Now, first of all, if we go to the information we have at the paragraph 3 up there, so the current financial year was all ended on 31st of or that is June 2021. So basically what that means is that this year started on 1st of July 2020. But now if we go back to the information we have in note number 4, we are told Pareto Limited disposed 60% of its investment in Dafu during the current year. So that is the 1st of April 2021. 1st of April 2021. So how many months do we have here to the date of consolidation? We have April, May, June. So here we have 3 months, and automatically here we have what? 9 months. So what that means is that for the first 6 months, this particular company here, that is Dafu, this was a subsidiary, because you can see in the first 9 months, the parent company had 100% shareholding. But on this date, we are told the parent company disposed 60% of its shareholding in Dafu. So that what that means is that the parent company retained 40% shareholding in Dafu, and therefore Dafu in the last 3 months was an associate. And therefore, if for example in this particular question here the examiner was requiring the candidate to prepare the consolidated income statement, it's very, very important to note that this company here, that is Dafu, for the first 9 months you treat it as a subsidiary, meaning that you take into account its revenue and expenses for the first 9 months, for the first 9 months, and then you add that to the revenue and expenses of the parent and the revenue and expenses of what? Of Paba. But in the last 3 months, that is, Dafu Limited will be an associate, and therefore what you need to include in the consolidated income statement is the parent company share of Darfur Limited profit after tax in the last 3 months. And also, in this case, because the parent company lost the control, you have to determine the gain or loss on disposal, which then you recognize in the income statement as part of the profit or loss. But in our case, if you check on what the examiner was requiring here, specifically in Part C, we are only required to prepare the consolidated statement of profit, the consolidated statement of financial position. So what that means is that in preparing that, we check the status, we determine the status of Darfur at the end of the year. Darfur Limited at the end of the year will be an associate, and therefore, in preparing the consolidated statement of financial position, we are going to add similar items of assets and liabilities, those of Pareto, the parent, and those of Paba, but we are not going to take into account the asset and liabilities of Darfur because it's an associate. So what we are going to do is we are going to determine something called the investment in associate, and basically that is the only item we are going to include in the consolidated statement of financial position as far as Darfur Limited is concerned. Yes, that is why the group structure here is important. But before you do that, maybe you can just go through this additional information again. We see whether there are some workings which are required. Note number 1, we go back to note number 1. We are given information about the acquisition of Paba, and actually the retained earnings, the purchase consideration, all that will be used in the computation of goodwill, which you are required to compute as per part 1 of that question. And also we are told that at the date of acquisition, Paba Limited, or at the acquisition of Paba, the only adjustment required to the identifiable net asset of Paba was a LAD with a carrying value of 625 million less than the fair value. So basically what that means is that this company on the date of acquisition devalued the assets, and remember that process we refer to it as the fair value adjustment or the fair value exercise. So this is by Paba Limited, and the asset it revalued was LAD, and we are told that this LAD had a carrying amount of its carrying amount was 625 million less than the fair value. So in this case, the carrying amount was less than the fair value with an amount of 625 million. In other terms, we can say that the fair value, we start with the fair value, was greater or was more than the carrying amount with 625. So automatically, what is this? This is the revaluation gain. And this particular revaluation gain, which occurred on the date of acquisition, automatically was not accounted for by Paba. So therefore, in preparing the consolidated statement of financial position, this one we added to the group PP, and number 2, this one we treat it as a pre-acquisition revaluation reserve, pre-acquisition revaluation reserve. In computing the goodwill on acquisition, that will be one of the component of the net worth asset of Paba Limited. So I think we have that particular information there. And then it is also important to note that this particular asset here, that is LAD, this is not a depreciable asset. LAD is not depreciated, and therefore in this case, no depreciation other charge. No depreciation other charge to be computed here, simply because LAD is not depreciable asset. But if this was a depreciable asset, we needed to compute the depreciation other charge. So let's move to, but we will still come back to that particular point, specifically in answering part A of that question when computing the goodwill. So in number 2 is about information regarding the computation of goodwill. We will still use that in answering part A. And then part additional information number 3, we are given information about the acquisition of Pareto, where we are told the parent company, that is the acquisition of Darfur, whereby we are told Pareto Limited had acquired 100% shareholding in Darfur some time back. We are given it retained earnings there, and also the fair value of identifiable assets, which we are told equaled to the year carrying amount. So mean that at the date of acquisition, this company revalued the asset, and the fair value of identifiable asset was equal to carrying amount. There was no revaluation gain or loss. And then you're given the purchase consideration, which was 5750. All that information, we're going to use it in answering part A, specifically in computing the goodwill. And then we're given information number 4 about the disposal of some disposal of interest in the full. And also this one, we're going to use it in answering part B of that particular question. And then we have note 5, note 6. I think no working which is required here. So I think we can go straight to part A of that particular question. Part A of the question. So what we are required to do is to compute the goodwill arising on acquisition of investment in subsidiaries. Investment in subsidiaries. So we start by computing the goodwill arising on acquisition of the first subsidiary here, that is PABA. So let's start by computing the goodwill arising on acquisition of investment in PABA Limited. PABA Limited. Equally, remember, as per the information which are given in note number 2, we are computing the goodwill using the full goodwill method. That's the first thing you need to appreciate, or basically to note. So how do we compute the goodwill using the full goodwill method? Number 1, we take the cost of investment. So how much purchase consideration was paid by the parent company in acquiring the shares of PABA? So that information, we have it in the balance sheet or in the statement of financial position of Pareto, specifically under the non-current asset. We are given the amount invested by Pareto in PABA, which is 8,500. So to this, then we add the NCI at fair value, because you're using the full goodwill method. So this figure is also given in note number 2. Additional information number 2, the last sentence, we are told at the date of acquisition of PABA, the non-controlling interest had a fair value of 21.25. So we add the 2. So this will give us 25, 10, 6, 10, 6. So let's confirm whether that is correct. So we have 85 plus 21.25. So which will give us 10,625. That is correct. So then from there we proceed and we less fair value of net assets. Fair value of net assets acquired. So how do we compute this one? Because it's not given. So we have to determine the fair value of a net asset of PABA on the date it was acquired. And we determine that by taking the ordinary share capital of PABA plus pre-acquisition reserves. So therefore, where do we get this? Let's go back to the statement of financial position of PABA, specifically under equity. So under equity, number 1, we are given the ordinary share capital of PABA. The ordinary share capital of PABA is a figure of 25. Still, in that case, we also have a share premium. Share premium of a subsidiary company, unless told otherwise, is always taken to be a pre-acquisition. Then the retained earnings, which we have there of 5250, that is at the end of the current year. That is not what we're interested with. We're interested with the retained earnings of PABA on the date it was acquired. And that is now what we refer as the pre-acquisition retained earnings. So that one is given in the additional information number 1, whereby we are told when PABA Limited was acquired, its retained earnings stood at 35. And then to this, other than taking now the items in the statement of financial position, specifically under equity, you also have to check whether this company reversed the full limited. The full limited. So we need to have 2 columns here. And even before you compute now the goodwill on acquisition of DAFU, it is very, very important for you to note that in DAFU, there is no NCI here. There is no NCI because you can see that the parent company acquired all the shares, acquired 100% of the shares issued by what? By DAFU. So therefore, in DAFU, we don't have what? NCI. And that's why you can see, despite the group using the partial goodwill method, the full goodwill method in computation of goodwill, we are not given the NCI at fair value in DAFU, simply because there is no NCI. So therefore, what we do here, we take the cost of investment, the purchase consideration paid by the parent company, that is Pareto in acquiring shares of DAFU. That one is given in the statement of financial position of Pareto under the non-current asset, which is 750. And then in this case, we should add the NCI at fair value, which you are saying is 0 because we don't have NCI. We don't have NCI. We get 5750, and then to this we proceed with less fair value of net assets acquired. Equally, to compute this, we take the ordinary share capital of DAFU plus pre-acquisition reserves plus the reserves it was having on the date it was acquired. So where do we get that? Let's first of all we go to the statement of financial position of DAFU, specifically at the equity section. So the ordinary share capital of DAFU, is 2,000. Also, DAFU had a share premium of 500 and then the retained earnings in the statement of financial position of DAFU 5750 is at the end of the current year, but that is not what we're interested with. We're interested with the retained earnings of DAFU on the date it was acquired, and that is given in the additional information number 3. Pareto Limited acquired 100% equity interest in DAFU a number of years ago when it retained earnings. Earnings stood at 1750, and also you check whether DAFU Limited revalued its assets. So basically, as per the information which are given in note number 3, this company revalued its asset, but you are told their fair value was the same with the carrying amount. There was no revaluation gain or loss. So what we do, we get the total here, and then we less that from the figure we have down there. So we have 2,000, which will give us 2,500 plus 1750. So which will give us 4250, and then we take 100% of this. 4250, we less it from this figure minus 5750, which now will give us a goodwill of that, which will give us goodwill of 1500. So basically that also what was required there, and automatically the items to be marked there include what we have there, that and that. And basically by computing the goodwill on acquisition of the two subsidiaries, the marks allocated there were 4. So let's move to part B of that particular question. Part B, we are required to compute the gain or the loss on disposal of investment in DAFU, Limited, Roman 1, as it was reported in the individual financial statement of Pareto, as it was reported in the individual financial statement of Pareto. Now, in this case, when Pareto Limited basically invests, or the parent company invests in a subsidiary, to the parent company, that investment in some of the shares, or basically all the shares in a subsidiary, the parent company in its individual financial statement, not in the group account, in its individual financial statement, it will need to recognize the gain or the loss on disposal. Now, that gain or loss on disposal is computed by taking the sales proceeds. The sales proceeds is basically the amount of money which was received by the parent company after selling some of the shares or all the shares in the subsidiary minus the carrying amount of investment disposed. Investment disposed, or basically investment sold. And this one is very simple because all these figures are given. So let's go to the additional information number 4, and you're told Pareto Limited disposed 60% investment in Darfur on 1st of April 2021 for 4,700. So that 4,700 is the sales proceeds, the amount of money received. Yes, and then to this, what we know is that the amount of money which Pareto Limited had invested in Darfur is 5750, which is given in the balance sheet of Pareto. The amount invested in Darfur was 5750. In the statement of financial position of Pareto and current asset, the amount invested in Darfur 5750. But in our case, we know the parent company only disposed 60% of that. So that is the carrying amount of the investment sold. So that's how we compute the gain or loss to be recognized in the individual financial statement of Pareto. So this will give us what? 60%, 5750. We less that from 4,700. So this will give us 1200. And basically that is a gain. That is what? That is a gain. That is a gain. So basically by doing that, the candidates here were allocated how many marks? Were allocated 2 marks. 2 marks for computing that. You can see that was quite straightforward. Also in part B, we are required to compute the gain or loss to be or as it will appear in the group account, as it will appear in the consolidated statement of profit or loss. So this is now the gain or loss to be recognized in the group account. So this is something we discussed in our previous session, how to compute the gain or loss arising from disposal of interest. So in terms of how we compute this, we take a number of figures here. Number 1, we take the fair value of consideration which was received. How much amount did the parent company receive after selling the 60% stake or interest in Darfur? So that figure, we already have it in note number, additional information number 4, and which was 47. And then to this, we add the fair value of investment retained. Fair value of investment which was retained. Still, we have that in note number 4 as a figure of 4,300. The fair value of the 40% equity interest which was retained was 43. After adding those two figures, we proceed and we less two items. Number 1, we less the parent company unimpaired goodwill. Parent company unimpaired goodwill, and that is something we have already computed here. The goodwill arising on acquisition of Darfur, this figure here. And we also have to note that this particular goodwill here, despite computing it using the full goodwill method, this is a goodwill attributable to the parent company, because in this Darfur we don't have NCI. Because generally here what we take into account is the parent company goodwill which is not yet impaired. So this goodwill was not impaired as per the information given in note number 6, and the full amount is the goodwill attributable to the parent company. So that is what we less here. And then we also less the fair value of net assets at date of disposal. At date of disposal. So what was the fair value of Darfur Limited net asset on the date of disposal. That information, we also have it in note number 4. We are told on 1st of April 2021, the fair value of identifiable net asset of Darfur was 6250. Was 6250. So that's how we determine the gain or loss on disposal to appear in the consolidated, or to be recognized in the consolidated statement of profit or loss. So we have 47 plus 4700 plus 4300 minus 15 minus 6250. Yes, that will give us 1250, which is a positive figure, and that is a gain on disposal. The gain on disposal. And actually, that what was required in that part there, and basically by doing this, the marks allocated there were 2. So these are the items automatically which were marked. So let's move to part C of that particular question, whereby we are required to prepare now the consolidated statement of financial position, which you have said is simple, because what we need to do is to appreciate the fact that this will be a subsidiary at the end of the year, and then Darfur Limited at the end of the year, it will be an associate. So therefore, in preparing a consolidated statement of financial position, we combine similar items of asset and liabilities, those of the parent and those of the subsidiary. And then for Darfur, we just compute something called the investment in what? In associate. So therefore, let's do that. Part C. So the name of the group here will be Pareto. Pareto group. This is a consolidated statement of financial position as at 30th of June 2021. 30th of June 2021. So here we just need to have a single column, and our figures are in thousands of shillings, in million of shillings. So we start with the non-current assets. So first of all, we have the PP. So of PP, we are taking the PP of the parent, recall that, of the parent, that of PABA. We are not including those of Darfur. Darfur is an associate. We don't consolidate asset and liabilities of an associate with those of the parent. What we include here, as far as the associate is concerned, is something called the investment in associate. So therefore, we are only adding the PP of Pareto and those of PABA. We have 4900 plus 9250, and then we check whether we have any consolidation adjustment affecting the PP. Do we have any consolidation adjustment? Yes, this one. On the date of acquisition, PABA Limited revalued its asset upward with an amount of 625, which was not accounted for. So we add that here, 625. So remember, we don't have any depreciation other charge, which would have been deducted there. So then below the PP, we'd have investment in PABA, investment in Darfur. So those investment, we don't include them here, but as far as PABA Limited is concerned, which will be a subsidiary at the end of the year, we include its goodwill here. So the goodwill on acquisition of PABA is 3,000. And then for Darfur at the end of the year, remember, it will be an associate. So what we include here as far as the associate is concerned is investment in associate or investment in Darfur Limited. So in our previous session, we looked on how to compute this, and actually we said to compute investment in associate, we take the investment, that is, we take the fair value of the investment which has been retained. So which is what you are given here, 43. And then to this, what we add is the group share of the post-acquisition net asset in that Darfur. So how do we get the group share or the parent company share of the post-acquisition net asset in Darfur? So what we do is that we take the net asset of Darfur at the end of the year, and basically by now we know that the net asset of a subsidiary is always equal to equity, share capital and reserves. So what is the equity of Darfur at the end of the year from its statement of financial position? You can either take the asset minus liabilities, or you just take equity. The total equity of Darfur, which is the same with the net assets, is 8250. This is the net asset of Darfur at the end. But now the date Darfur Limited became a subsidiary, became an associate, sorry, its net asset, you have to recall in note number 4, we were given as a figure of 6250. So therefore, whatever the difference here is the post-acquisition net assets. So we get the parent company share of this, which will be 40%. Which will be 40%. So this will give us a difference of 2,000, 40% of 2,000, 40% of 2,000. This one is 800. We add it to this, which will give us 5,100. So that is now the investment in what? Investment in Darfur, which you are saying will be included here as an item of non-current asset. Okay, so then below that we also have the financial assets. Financial asset, no adjustment for this. We just take the financial asset of the parent, 31, plus those of the subsidiary, 28. This will give us 59. And then from there we have the current asset. Actually, for current asset, we are given the total, 3850 plus 4425. Do we have any adjustment to the current asset? We check for things for like intercompany debts. We don't have things like unreleased profit. We don't have. So means that no adjustment for this. So what we just need to do, we get the final figure. We get the final figure. We have 3850 plus 4425, which will give us 8275. We get the total assets. The total assets. So let's first of all we compute the figure for PP there. We have 14,900. There is something we have forgotten here before we add here. So this particular purchase consideration which was received, that is a figure for 47. This amount was not yet accounted for. So therefore is amount receivable. It was not yet paid. So we also include it as part of the current asset. We also include it as part of the current what? Asset before we get the final figure there for PP. So let's add 47, 8275, 8275 plus the purchase consideration received, this one, which will give us 12,975. Okay, so we get the final figure for PP. We have 49 plus 9250 plus 625, which will give us 24, that is 24,775. Yes, and then we can add all these figures now, plus 3,000 plus 51 plus 59 plus 12,975. So that will give us a total of 51,750. So these are total assets. So we proceed, record equity. So for equity, we record the ordinary share capital, that of the parent company only, which is the 10th is an associate. So then from there we have non-current liabilities. So for non-current liabilities, we are given the total. So we have 85 for the parent, and that for PABA, no adjustment here. So we get a total of 14,500. And then we have the current liabilities. Current liabilities, we have 47,75 plus what? Plus 17,25. We don't have any adjustment there. We get total equity and liabilities. Total equity and liabilities. Total equity and liabilities. So let's first of all we add this particular figure. We take it retained earnings at the end of the year. The retained earnings of PABA at the end of the year in the statement of financial position is 50.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Ningwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta for each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A, you can see the average right over here. And the average of what? We want to pick the average for Z-Term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You're told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the All Share Index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the All Share Index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the bracket, and we enter. So I think I didn't put I didn't put open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD, stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term, so we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till All Share Index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already have the standard deviation over here, compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here, so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here, so we open the brackets there, and then we multiply that with car assemblers, corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So we pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or covariance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, so we are saying this one for G is one that you can be able to decide to lock, F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay like that, because that's just the covariance like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var p but var s, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets. There, that's our beta, 0.0932. And if we are to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1, because it's covariance of the market, it's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We always here for you. Be blessed. Hello learner, welcome to Manifested e-learning platform. My name is FAM Lengwiri and I practice within the financial services industry in Kenya. Today we are discussing on the financial modeling and data analytics paper. The focus is on the December 2023 sitting. We are going to discuss on question 21. The question reads as follows. Eugene Shahira has been provided with a set of historical data by one of his clients, which include a set of assumptions, statement of comprehensive income, statement of financial position, statement of cash flows, and supporting schedules as presented below. And so you can see down here the assumptions. These are the assumptions that have been given to us here, and you can see they're presented in blue for the forecast period, and this is the historical results. We have the income statement, the balance sheet given to us down here, and the cash flow statement just under it. Finally, we have what is called the supporting schedules. We are required we are required, using the assumptions presented in the assumptions table, assist Eugene to complete the following statements of forecast period for the forecast period. A, the statement of comprehensive income, the statement of financial position, the statement of cash flows, and the supporting schedules. All of these total to 30 marks. So we go back up and start filling out the income statement based on this forecast period right over here. So the forecast period is from 2017, and we are going to start with the income statement. So the revenue, to model revenue, we have been given the revenue growth rate over here, and so we are saying that we are going to assume that the revenue is going to grow at 5% initially, 4.5%, 4%, 3.5% and 3% in 2021. So we will increase this 150,772 by a factor initially of 5%, 4.5, and so on and so forth like that. So let's do that together. So the first thing is to link it with that, and then we multiply by that factor 1 plus now this growth rate right over here, and we close the bracket so that now the model can be complete, or the formula can be complete. You can see in 2017 we expect it to be like that. So we drag it, Control R, and it picks the formula like that. Else we can do the following. If we don't prefer to do it like that, we just focus it like that, and we wait for that plus sign over here like so, and then we drag it like that. So we drag the formulas, and you'll still see the answers are the same. How do we model cost of goods sold? Now we are told that the cost of goods sold is provided as a percentage of revenue. Meaning what? We get the cost of goods sold over revenue gives us 37.5%. I can do it right above, right beside it here. So you can say COGS over revenue will give us the COGS percent, which is this one right here. But how then can we use the COGS percent to be able to model the cost of goods sold? We just get the revenue and multiply it with the cost of goods sold percent, so that now we can be able to model the cost of goods sold, because that is what we're going to remain with over here. Because cost of goods sold over revenue is cost of goods sold percent. So we cross multiply the revenue multiplied by the cost of goods sold percent, then we should be able to have the COGS. And that's what exactly we are supposed to do. We take that and we multiply, or the revenue, we multiply that with what is called the cost of goods sold percent as a percentage of revenue. Enter there. And like the same way we've done before, we just drag it, Control R. The gross profit, because it's a formula, we just drag it, Control R. Now we move on to the expenses down here. So the salaries and benefits, what are we told as far as the assumptions are concerned? We are told that the salaries and benefits are given to us in terms of shillings, 25,000 all through like that. And here we're saying it's going to remain as 10,000 in terms of the depreciation component. So because they're following each other like that, and these are considered to be fixed costs, we just pick them from above. There, just pick it up from there. And also because they're following each other, just drag it like that, put it like that. And then now, fill it out like that. What I've just done, I've just picked this one from here. And you can see from here, this is I32. Like that. So it's I32, which is this cell over here. But now, where do we pick it from? We pick it from I13. This is I13. I13 is this one here. So we're picking it just from there. And then also this one is going to be I14, which is down there. Now we move ahead and try and model the depreciation and amortization. In real life, trying to model depreciation and amortization will prove to be a bit of a challenge. Determining would be a bit of a challenge because we need to know whether it's going to be reducing balance or whether we're going to use straight line method. For simplicity's sake, the way I've gotten, I've seen it right over here, depreciation as a percentage of PPE, it's just based on straight line method like that, for simplicity's sake. So the depreciation and amortization is driven by percentage of opening balance of PPE. So we will initially leave it over here because we do not have the values of PPE given to us directly, and we'll model it a little later on. As well, the interest right here, the interest right over here is based on opening balance. We do not have the opening debt balance given to us here. So what do? We first of all leave those two alone like that, and we will be able to try and model them a little later on. So we put maybe say a faint color there on them, like so, to show that we're going to come back to it a little later on. Because these are totals, the ones in black are always totals, the ones in blue are hard coded values. We just drag them. That. Remember that this value here is bound to change, as well as this value is bound to change because of we've not filled out the depreciation, neither have we filled out the interest. Now the taxes over here, we have been told something about the tax rate right above here. You can see the tax rate is as a percentage of earnings before tax, and you can see it's 28% all through. So what does that mean? That this tax rate will be based on that value times the taxation rate which is given to us right here. So we link it with that one there. And because this is also going to change based on these values given to us there, we just drag it, and because Excel is very wonderful, it's a very wonderful tool, it will just pick everything, or it will pick the formulas based on the values that are inserted right at this point here. This is a formula, so we just drag it like that, moving towards the right. So we have partially filled in the income statement with the exception of depreciation and interest expense. We move over to the balance sheet and try and model it and see if you can be able to model some items. Cash will be the very final part that you're going to fill out, and it will be like what is called the balancing figure as we approach the end of the model itself. How do we model accounts receivable? The accounts receivable, if we can go back to the assumptions section over here, this is the assumption section right above here, you can see we've been given accounts receivable days. We've been given 18. And accounts receivable days is driven by revenue. So it is accounts receivable over revenue times 365. We can get this from these black formulas over here. So if you double click, you can see it is the revenue, or it is rather the accounts receivable. Yes, if you said before, accounts receivable. We divide that with the revenue, and then we multiply by 365 to enable us get the days. Now that we've assumed that the days are going to be 18 over here for the forecast period, and you can see this is the forecast period here, 2017, how do we model the accounts receivable here? We are going to move ahead and say that it is accounts receivable, like that, is given as how we're going to model it over here. We'll pick the revenue, because we've said that we already have the accounts receivable days, and then we divide that, or rather, let me just tell you what you're going to do, because the formula is given to us right over here. You can see this is it over here. We are saying we're going to get the revenue, or rather the accounts receivable over the revenue times 365. So we're just going to do this. We are going to pick the days over here, accounts receivable days. So accounts receivable is going to be given as the days and then we multiply that with the revenue, and we divide this, all of this, by 365. By 365. Over here, 365. That. So days times revenue over 365. We've just adjusted the days. Initially, for us to get the days, we're saying we get the accounts receivable times 365 over revenue. Just rearranging this formula. And that's exactly what we're going to do over here. We get the days. The days are here. See where they are. Just a second. Accounts receivable days. There. And then we multiply that with the revenue. Then we divide over 365. And we have that value given to us there. So shift, control R, we model that. Inventory is driven by cost of goods sold. So in a similar fashion over here, the formula here, we'll get inventory is given as, or given by, the inventory days times COGS, not times revenue. And here we're dividing against 365. That. So that's what we expect over 365. So that's what we are going to do. We pick the cost of goods sold there, just to double check, cost of goods sold times the days. Which days? The inventory days right here, 73, divide by 365. Once we divide that by 365, then we should be able to get the 11,715. We drag it. PPE, or property, plant and equipment. Remember, this is the one that is going to drive our depreciation component over here. But since we don't have it yet over here, we leave it out for now. The second time coming down, we will be able to fill it out. Because this is a formula, so shift, control R. We can proceed on to the liabilities. Obviously, these values are bound to change because we've not filled out the cash, neither have we filled out the PPE. So the accounts payable is driven by cost of goods sold. The same formula over here, only that we're going to put now accounts payable. Now over here, payable. Payable for revenue 365. So we look for the accounts payable days. Accounts payable days, you can see the accounts payable days are here, 37. And then we multiply that with the cost of goods sold. And then divide by 365. That's what we get. The debt, we will be able to fill out the debt and link it with the debt component from the supporting schedules. So here we drag it like that because this is a formula here, it's just the total. So this one I'll put it in a different color so that for consistency's sake to maintain, to show that this is the part you're going to come to later on and fill it out. In terms of the equity capital, we are going to link it. So we're going to drive it previous equity capital. Then we add any new issuance and repayment of equity. So we come back up over here to the assumption section, this assumption section. Was there any issuance and repayment of equity from 2017? There is what we link it with over here. And we enter. The retained earnings is driven by the previous retained earnings plus the net earnings for the current year, which is this one here. Remember, this value is going to change because of these two, depreciation and interest. Enter. We drag them towards the right, and this one remains like so. So shift control R. So it picks the formulas as the way they are. Remember, in a balance sheet we always have a check. This check, with your permission, it will obviously not balance because we are saying that here we have got some missing items. You can see it's not balancing at all. But it's up to our responsibility, based on what the examiner has asked us, to feel and ensure that this one balances off, the balance sheet balances off based on the forecast. Now, as far as the cash flow statement is concerned, we will first of all ignore it for now. We ignore the cash flow statement, and we will be able to also do a check for the cash flow statement and write down over here to determine if we are actually cooking figures or not. We jump onto the supporting schedules. These supporting schedules are broken down into three: the working capital schedule, the depreciation schedule, and the debt and interest schedule. These schedules, these three of them, are instrumental towards filling in the missing items in the balance sheet, income statement, and the cash flow statement. So from here, the accounts receivable, you remember we had modeled it just above there in the balance sheet. So we just fill it out, link it with the one accounts receivable here, and you can see the accounts receivable is here, so we link it right over there and we put enter. Because they are following each other with the inventory, I can just drag this sort of down like that, and it picks from above. The accounts payable, we also had filled it out or computed it above from the balance sheet here. The accounts payable, as you can see right over here, is 5938. You see, it's okay. Link it like so. Then these are black. It means that they are formulae. To get the net working capital, we get the accounts receivable, we add the inventory, and then we less the accounts payable. That's how we get the net working capital component. So just put it like that, and it picks. The change in net working capital is the difference between changes in this year from last year's. You can see the formula there. This value subtracting that value there. So I'll initially fill it like that. Then now I can drag it moving down like that. Shift, Control R. So once we have those values given to us there, we are saying that now the working capital schedule is complete. The change in net working capital is going to be useful in computing some items in the balance sheet or in the in the cash flow statement, pardon me. So we move down to the next supporting schedule, depreciation schedule. Now we can see something that is very unique from the historical values here. This value, which is the opening PPE, is picked from the closing value here. This value has been picked from the closing value here. This one has been picked from there. So it goes without saying that this value here will be picked from the value there. How much is our capex? Our capital expenditure is representative of how much money we are going to spend out within the year. Outflow of cash, maybe to invest in new machines, new equipment, so forth. And we will link this with the supporting schedule up from, rather not the supporting schedule, the assumptions section, this one here. And we are saying that the capex, capital expenditures over here, is given to us there. So we link it with that and we press enter. The depreciation is based on the opening PPE always. So we pick the opening value of PPE and multiply that with the depreciation rate. Remember, we are saying that we are assuming it for simplicity's sake is going to be straight line method. So depreciation, and we are saying we are going to multiply it with that. And we get that. To get the closing PPE, we are saying we are going to get the opening PPE, we add the capex and less the depreciation on the machines. So we drag the formula moving to the right like that, and we can sort of pull the formula towards the right or drag it. Now the final supporting schedule is the debt and interest schedule here. How do we model it? The debt opening, just like the way we are done in the opening in the depreciation schedule, this value is that value, that value is that value. So it goes without saying this value is going to be that value. So pick it from there. And the issuance and repayment of debt can be gotten from the assumptions section, which is up over here. So debt and issuance repayment right now here, we link it with that. So here, because it's a formula, we just drag it. So we drag it over here, it's like that. We wait for the plus sign that looks black like that, which is over here like this, and then we sort of drag it. We just drag it moving towards the right. How do we get the interest expense? The interest expense is based on the opening value times interest on the assumptions section. Interest, the percentage of opening balance here is 3%. Now our schedule, or our supporting schedule rather, is complete. That's what we're saying we're going to do. We drag it. These values over here are going to be instrumental towards filling out the cash flow statement. But first, let's go back up and start all over again from the income statement here and fill out what is missing. We have the depreciation component, so we link it with the ones in the supporting schedule. So we go down on here, and you can see the depreciation is given to us over here. There, enter. The interest expense right here, interest expense is linked to the supporting schedule here, right here, enter. Then we can be able to just drag it towards the right there, Control R. And in a good account or analyst format, we just make sure that this part is the same color because we've already filled out the missing items and our income statement is complete. Now, like I said before, that the cash is going to be filled out at the last, at the tail end. It's like the balancing figure. We can fill out the property, plant and equipment. So we're saying it's going to be from the supporting schedules down. So we are saying it's going to be this value here, the closing. You're reporting at the end of the financial year. So we pick the closing balance there, and we drag it towards the right. Remember, it's just the sum of all of them. As well, the debt, we pick the closing debt, which is right here. Closing debt should be that. We can just drag it, Control R. So we can then, of course, now remove the theme color, put it here like so, with the exception of the cash. Now let's fill out the cash flow statement. Net earnings is picked up from above here. Here 35 is here, the net earnings, you can see the net earnings is there. Here we have the depreciation and amortization over here. Right here, so you pick that. And then we are saying changes in working capital. Where do we pick it from? We pick it from the supporting schedules right here. Change in net working capital, and we are saying we are going to pick that value. So because this is black and it's a formula, I can just drag it like so. Now we're almost there, but we're not there quite there yet. The investments in PPE represent the capital expenditures. So the capital expenditures down here, capex, you can see the capex is here. Link it to that. And this one, sort of pull it towards the right, and it's complete. As far as the financing cash flow is concerned here, issuance and repayment of debt, we link it with the supporting schedules, rather with the assumptions tab, sorry, up, debt, here. And remember, they are following each other with equity. So, like that. And this can be dragged like so because it's a formula, and we can complete this by doing that, by dragging the formulas moving the right. The net increase or decrease in cash is a formula because you can see it right above over here. We're going to add cash from operations. We subtract cash from investing because that's money going out, and then we add cash from financing so that we can be able to get the decrease or increase in cash. Drag that towards the right. And we're saying that we can then pick the opening cash balance. Remember, this opening cash balance is the closing cash balance here. This one is that one, and that one is that one. So we are saying that we can then link that with that value. This one is a formula like so. So we can then drag these values moving towards the right, and we have the values like so. Now to try and test and see whether this is actually going to balance, because we are through, answered the statement of comprehensive income, statement of financial position, statement of cash flows, and the supporting schedules, we can see that it's still not balancing. Remember one thing, what I had mentioned, that the cash balance is the one that is the balancing figure right here. So let's try and see if you're going to link it, if it's going to balance. So we link this cash value with the closing cash balance right here, this one here, and you can see it has balanced. But dragging the rest towards the right is the one that's going to tell us whether we are on the right path. And you can see it has balanced very well. The cash flow statement has also balanced as well, meaning that we have successfully answered the question presented to us by Kasneb. We hope that you've enjoyed this session of ours, but before we part, there is one thing that I want to try and see and to ask you, whether even if we change these assumptions here, whether it will still balance. It will still balance. That may be the question. So even if I put this to 25 million like that and leaving the rest the way they are, look at the balance sheet. It still balances. If I put this to maybe 50%, that it still balances. So this issue or this idea of cooking figures cannot arise because Excel is truthful, and being a true financial analyst means that you need to know how to model all of the three statements: the income statement, the balance sheet, statement of cash flows, very well. Thank you for being with Manifested Publishers, and God bless you.
Hi student, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, your lecturer for Advanced Financial Reporting. So in this session, I want us we continue with the topic number 1, and I want us we look on this subtopic here to do with the accounting for employees benefit. So as far as this topic is concerned, we're going to look on a number of issues. One, we are going to define what are employees benefits. We look on the various types of employees benefits, and then later on we define some few terms. Then from there we look on accounting aspect of the two types of post-employment benefits, that is the defined contribution plan and the defined benefit plan. But to start with, let's start by defining what are employees benefits. And generally, when talk about the employees benefit, this refers to any form of consideration which is given by an entity to the employees in return or in exchange of the services the employees are rendering. So it is obvious that if you are an employee of a company, you offer some services to that particular company, and therefore the company must compensate you, or in other terms, the company must do what? Must reward you for your what? For your services. So therefore, any form of consideration is benefit. So therefore, we can start by defining what employees benefits are, and we say that yes, so therefore in this case we are saying that employees benefit refers to any form of consideration given by an entity or basically by an employer in exchange of the services which are rendered by who? By the employee. So what you have said is that if you're an employee of a company, you render some services to the company, and therefore the company must give you somewhat consideration for your what? For your services. Now in this case, we have various types of employees benefits, and actually we have 4 types of them. So we can look on the types of employees benefits. Types of employees benefits. So in this case, we have 4 types of employees benefits. So we can say that there are 4 types of employees benefits. Employees benefits, and those employees benefits, number 1, we have something called the short-term employees benefit. So when talk about the short-term employees benefit, this refers to those particular benefits which are payable to the employees within a period of 1 financial year from the date the services were provided. Or in other terms, you can say that these are those particular benefits which, and therefore good examples of these short-term employees benefits include the salaries, include the wages, and also the various allowances which are payable now to the employees, mostly on monthly what? Basis. So therefore you can say that these are benefits which are payable within 1 year, or basically within 12 months from the date the services were provided. In this case, we have said that good examples of this include the salary, which we know is payable on a monthly basis, and also these include wages. These include what? Wages. Number 2, we have post-employment benefits. So when talk about this particular benefit here, these are the benefits which are payable to the employees once now the employees proceed for the normal retirement. And generally now this what we refer as a pension. So basically what we know is that if, for example, normal or basically the retirement age, you are entitled to some benefit which is known as what? The pension. So that pension will be paid to an employee once now the employee proceed forward for the normal retirement. So therefore you can say, so these are those particular benefits which will be payable to the employees after the normal retirement. Basically, when we talk about the normal retirement here, we are talking of basically the period which now the employee will proceed for the retirement, basically after attaining the retirement age. And this, in other terms, what we refer as what? This, in other terms, what we refer as a pension. Number 3, we have something called the termination benefit. Termination benefit, or basically what we refer as a termination employees benefit. When we talk about the termination employees benefit, these are those particular benefits now which are payable to the employees as a result of the entity's decision to terminate now the employee's employment contract before the normal retirement age. A company may be undertaking restructuring, maybe to reduce the operating cost, and therefore the company intend to retrench some of the employees. So those particular employees will be retrenched automatically. They're entitled to some benefits which are known as what? The termination benefit. So therefore you can say that termination benefits, these are benefits or employees benefits payable as a result of an entity's decision, to terminate employees' employment contract, employment contract before the normal retirement, retirement. Then from there we have the other type of employees benefit, which is number 4, and that is what we refer as the other long-term employees benefit. So when talk about this other long-term employees benefit, we are talking of any other long-term benefit which now an employee is entitled to other than what we refer as a pension or what we refer as a termination benefit. A good example of what we refer as the other long-term employees benefit includes something called the Jubilee benefit. So Jubilee benefit are those particular benefits which will be paid to the employees whenever the company is celebrating its Jubilee. For example, if the company is celebrating maybe 10 years of operation, the company may decide to give some benefits now to the employees who have worked with the company maybe for the last 10 years or basically for the last 20 years. So therefore, the other long-term employees benefit, we can say that these are other benefits. These are other benefits payable to employees, other than the termination benefit, or what we refer as a post-employment benefit, or post-employment benefit. So therefore, in that particular case, it is important to note that we have those 4 types of employees benefit: the other long-term employees benefit, termination benefit, what we refer as the post-employment benefit, and then we have now what? The short-term employees benefit. So then from there we can proceed and look at post-employment benefit plan. So in this case, when talk about what we refer as a post-employment benefit plan, this refers to any form of arrangement or basically any form of agreement between now the company and the employees, that the employees will be entitled to a pension once the employees proceed for normal what? Retirement. So basically what that means that if, for example, you secure a job with a certain company and there is an agreement between you and your employer that once you proceed for your retirement, you'll be entitled to a pension, or basically will be entitled to what you refer as a post employment benefit plan, then that agreement is what you refer as what? A post-employment benefit what? A plan. So in this case, we are going to look on the two types of this and basically how we account for the same. But before we do that, maybe we can define this and we say that this is a formal or informal arrangement between employer and employees, that the employees will be paid a pension after the normal retirement. After the normal two types of post-employment benefit plan, and actually this one we abbreviated as a post or PEBP, post-employment benefit plan. So I've said that we have two types of this. So you can look on the types of a post-employment benefit plan, the defined contribution plan. So when talk about the defined contribution plan, it is basically a type of a post-employment benefit plan whereby both the employer and the employee contribute a fixed amount of money, and then that amount of money will be transferred to a fund or basically to a trustee. A good example of such a fund or a trustee is NSSF. Once NSSF receives those particular contributions by both the employer and the employees, it is supposed to invest it so that it will be earning some investment income, which then will be used by that particular fund or trustee in terms of paying pensions now to the employees who have done what? Who have retired. So therefore, the first type of this is what you refer as the defined contribution plan. And basically we are saying under this particular type of post-employment benefit plan, the contribution by both employer and employee and employees is defined. By being defined means that the amount to be contributed by both the employer and the employee, that amount is known in advance. For example, if today you secure a job with a certain company, the amount of money which you should contribute toward NSSF, that amount you know it in advance. Currently, most of the employers and employees are contributing an amount of 1080. The employer contribute 1080, the employee contribute 1080, and then that amount of money will be paid or basically will be transferred to what? To NSSF. So therefore, in this case, we are saying the contribution by both the employer and the employee is defined. In other terms, we say that that particular contribution which both the employer and the in advance, and actually that's why we refer to this type of post-employment benefit plan as a defined contribution. The contribution here is defined. The contribution here is known in what? In advance. And what you have said is that once this particular contribution is made by the two parties here, the employer and the employee, then it will be transferred to a fund or basically a trustee. And I've said a good example of such a fund or trustee is NSSF. Is what? NSSF. So then we can say that the contribution will be transferred to a trustee, or a fund, e.g. NSSF, that is National Social Security Fund. That is a fund, or in other terms, it is a trustee, and it is supposed to do what? To invest those particular contributions so that it will be earning some income, which then will be used in terms of paying what? The pension to the employees who have done what? Who have retired. And in this case, it is also important to note that once the employer here has made his contribution, he does not have any obligation in terms of paying your the pension. So we are saying the employer will make a contribution and then he transfer that amount of money to what? To this fund or trust, to this fund or trustee. The fund or trustee is the one which has the obligation to pay the pension to the employees who have pension. The amount of post-employment benefit now which the employee will be paid is not defined, is not known in advance. For example, in this case here, as an employee, you don't know in advance the amount of pension you're going to do what? To receive. So the pension which you're going to receive will always be equivalent to the contribution which you have made during your employment, plus now the interest which has been earned by that particular what? Contribution, because we are saying once these particular contributions are made, then they will be transferred to what? To NSSF. And NSSF will invest that, and therefore the contribution which is made by the employer and the employee keep on growing on an annual basis based on the return which is earned by that particular what? Fund or what? Or trustee. And therefore, maybe the other important we can mention here is that the pension to be paid or to be received, that is, to be received by an employee, is not defined. Is not defined. So basically, an employee does not know in advance the amount of pension he will be able to do what? To receive, because we are saying whatever he will receive as a pension will always depend with how well the investment undertaken by this particular trustee, by this particular fund are what? Are performing. So therefore, that is the first type of the post-employment benefit plan. So let's look on the second one, number 2. So number 2, we have something called the defined benefit plan. Defined benefit plan. So when talk about a defined benefit plan, as the name suggests, this is a type of a post-employment benefit plan whereby the pension, or in other terms, whereby the post-employment benefit which an employee will receive upon attaining the retirement age is defined. Is what? Is defined. So basically what that means here is that once you secure a job with a certain company, then you agree with your employer the amount of pension you are going to be what? To be paid. And therefore here it is upon now the employer to be able to do what? To estimate the amount of money he needs to be contributing on an annual basis, which will be enough to raise an amount of money which will be able to pay the pension which you have been promised by your employer in what? In advance. So therefore, we can say here the pension or post-employment benefit which an employer will receive, or basically that is employee will receive upon retirement is defined. Employee will receive is known in advance, i.e. it is known in advance. Known in what? In advance. So in this case, I've said once you secure a job with a certain company, you agree in advance the amount of pension which your employer will pay you upon attaining the retirement what? Age. And therefore, what you have said here is that the employer has a responsibility to try and estimate the amount of contribution he needs to be making on monthly basis, and the amount which equally need to be contributed by the employees to be able to raise enough amount of money to pay that particular what? To pay that particular pension. And therefore, we can proceed and we say that if the contribution which will be made by the employer will not be enough to pay this particular a pension, then the employer has an additional responsibility to come in and cover the shortfall. So therefore you can say if the contribution made by employer and possibly the employee is not enough, enough to meet the pension promised, the employer has an additional obligation. Employer has an additional obligation to cover the shortfall, So what we mean by this is that assuming you secure a job with a certain company, and that company promise that once you proceed for your retirement, then the company will pay you a pension of say 5 million. So in this case we are saying the employer has the responsibility of trying to estimate the amount of money he needs to be contributing on monthly basis to be able to raise an amount of money which will be able to pay that particular pension. And maybe let's assume that by the time you'll be proceeding for your retirement, the amount of money which will be contributed by your employer, maybe together with the interest which has been earned by that particular contribution, for example, equal to 4 million. So in this case, you can see the total contribution made by your employer and also the interest which has been earned by that contribution is coming to 4 million, which now is not enough to be able to pay this particular pension which your employer promised you. So therefore, what that means is that there is a shortfall, or in other terms, there is a deficit of 1 million. So in this case now, your employer will have to come in and basically cover this particular shortfall here of 1 million, because there is a concrete agreement between you and your employer. By the time you'll be proceeding for your retirement, then you are going to be paid a pension of 5 million. That's why in this case we have said that if that contribution which will be made by the employer and possibly the employee will not be in a position to meet that particular pension which was promised, then you are saying that the employer here has an obligation to come in and basically cover the shortfall, or basically that particular deficit. So therefore, in this case, we have those two types of post-employment benefit plan, the defined contribution plan, and basically I've said that this is the common type of post-employment benefit plan which is operated by most of the employers, especially in our country. And then we have the other one, which is the defined benefit plan. It will promise you in advance the amount of pension you're going to receive by the time you'll be proceeding for your retirement. So at a later stage, we are going to look on how these two types of post-employment benefit are accounted for. And as we are going to see, in terms of how this type of post-employment benefit is accounted for, that is the defined contribution plan, it is quite simple and straightforward, because what now the employer account for here is the total amount he has contributed on behalf of all employees. So that amount contributed by the employer on behalf of all employees is actually recognized as an expense. If, on the other hand, maybe the employer has not contributed maybe a certain amount of money when the year is coming to an end, that will actually be recognized as a current liability. And also, on the other hand, any excess contribution by the employer, it is accounted for as a current asset. So though we are going to discuss that in details, and also we're going to look on how this is accounted for, the defined benefit plan, we are going to see that in terms of how this is accounted for is a little bit complex due to a number of reasons. But even before we look on how we account for those two types of post-employment benefit plan, I want us to define some few terms which you're going to come across in accounting for the two types of post-employment benefit plan. So let's look on definition of those terms. So we have a definition of terms. So the first term we need to define here is the term funding. Funding. So when talk about funding, basically, this is a process through which now the contribution by both the employer and the employee will be transferred to a retirement benefit scheme. So we can say it is the processing is that particular process through which now the contributions made by both the employer and the employee will be transferred to a retirement benefit scheme. Like generally what we have said is that today, if you work with a certain company, you contribute a certain amount of money as an employee. Your employer will contribute an equivalent amount of money. Currently, we have said that the amount which is contributed is 1080 by the employer. The employer will contribute the 1080 and the employee the same amount. And then what happens is that this particular contribution will be paid to NSSF by 15th of the following month. So that process, we refer to that process as what? As a funding. So the other term which you also need to define here is something called the funded scheme. Number 2, we have a funded scheme. So when talk about a scheme generally, this is a type of a plan. Funded scheme is a type of arrangement whereby the contribution by both the employer and the employee will be transferred to an external entity. An external entity is basically an entity not within the control of the employer. Like generally what happens in Kenya is that once you make a contribution as an employer, as an employee, your employer make a similar contribution, that amount of money is paid or is transferred to NSSF. NSSF is basically an external entity. It's not an entity which is within the control of any employer. So such a type of arrangement, we refer to it as the funded scheme. So therefore, we can say that this is a plan where contribution by employer and employees is transferred to an external entity. Transferred to an external entity, e.g. NSSF. And therefore, the employer do not have a control in terms of payment of the pension. So once you retire as an employee, what you do, you go to NSSF and basically you claim your pension. You claim your what? Your pension. The responsibility of the employer, employer here is purely to contribute a certain in terms of the payment. So mean that if, for example, there is a delay in terms of payment of your pension, that is not something which is within the control of your employer. You have now to go to NSSF and ensure that your pension is paid. And then from there, we have the other term here, which is unfunded schemes. Unfunded scheme. So when talk about unfunded scheme, this is the direct opposite of funded. And therefore, the unfunded scheme is a type of a plan, is a type of arrangement whereby the contribution by both the employer and the employee will not be transferred to an external entity, but rather it is retained by the employer and managed by a retirement benefit scheme, which is under the control of the employer. Which is under the control of what? Of the employer. So mean that here, other than the employer making the contribution, he has a responsibility to ensure that the pension is paid, because the retirement benefit scheme here, we are saying, is under the control of who? Of the employer. So therefore, you can say that this is a plan, where contribution is not transferred to an external entity. But in this case, we have said that the contributions which are made by the employer and the employee will have to be retained and also managed by a retirement benefit scheme which is under the control of the employer. The other term, number 4, is something known as a plan asset. A plan asset. Now, what are plan asset? Plan asset, this refers to any asset which is owned by a retirement benefit scheme. Remember, what you have said is that once the retirement benefit scheme, e.g. NSSF, receive the contribution from the employees and also employers, money. So as a result of making those particular investments, there will be those particular assets which are under the control of such a retirement benefit scheme. And therefore, those particular assets are the one we refer to, to them as what? The plan asset. So therefore, you can say that this comprises of, number 1, what we refer as assets are held by a retirement, e.g. NSSF. And this particular asset here, what we have said is that they are intended to generate some income, which then will be applied, which then will be used by, for example, NSSF in terms of paying what? Pension. One of the main lender to the government. It invests in treasury bills, treasury bonds. NSSF also own a number of real estate. It own a number of buildings which generate some rental income and so on. So those particular assets, including investment in government securities, including investment in real estate and so on, those are good examples of what? Of a plan asset. And we are saying these assets are intended to generate some income and then which will be used in terms of paying pension to the employees who have already retired. And then number 2, plan asset also include qualifying insurance policies. Qualifying insurance policies. When talk about qualifying insurance policies, these are insurance policies procured by a retirement benefit scheme, whereby a retirement benefit scheme contribute an amount of money, maybe on monthly basis, and those particular insurance policies are then supposed to mature after a given period of time, say 10 years, 20 years, and then that retirement benefit scheme will start receiving some lump sum, which then will be applied, which then will be used in terms of paying what? Pension to the employees who have already done what? Retired. So therefore, the plan asset comprises of those 2 items there. The other term we need to define here is term number 5 is the present value of defined benefit obligation. Present value of defined benefit obligation. So when talk about this one, it is the present value of the expected future payments required to meet or basically required to meet the pension to be paid to the employees who have already done what? Retired. Remember what you have said is that if, for example, you secure a job with a certain company, that company can promise to pay you a certain amount of what? Pension, and which you are going to agree with your employer. So that particular pension which you are going to be paid and which has been agreed in advance between you and your employer, we have referred to that as a defined benefit. A defined what? Benefit. So basically what that means is that if an employer is operating the defined benefit plan, then the employer know with certainty the amount will be retiring. So meaning that the amount now to be payable in the future to the employer is a liability, or in other terms is a long-term liability. And because that amount is known with certainty, it can be measured reliably, then it must be recognized as a liability, and it's only recognized on a present value basis. So mean that if an employer expects to pay like 100 million in 20 years time, so he must recognize that as a liability, but that can only be recognized on a present value basis. It has to be discounted. It must be what? Or its present value must be estimated. So we can say that this is a present value of expected future payments expected future payment required to settle required to settle, or in other terms, required to pay the pension to retired employees. Number 6 here is something known as the net defined benefit liability stroke asset. And basically this fair value of the plan asset and the present value of the defined benefit obligation. Any difference between these two values here, the fair value of the plan asset and the present value of the defined benefit obligation, we refer to that as a net defined benefit liability or asset. So actually we can say that this is the difference between a fair value of plan asset and present value of defined benefit obligation. So mean that if, for instance, you take the fair value of the plan asset, and then to this you less the present value of defined benefit obligation, you can get a positive figure there or a negative figure. So you can get a positive figure there or a negative figure. So if we get a positive figure, we refer to that as a net. The figure here is known as a net defined benefit liability because the present value of the defined benefit obligation is more than the fair value of the plan asset. So therefore, that's how we determine the net defined benefit liability or benefit asset. So let's proceed and look on the definition of the other term. Yes, so the other term we need to define here, which is number 7, is the term current service cost. When we talk about the current service cost, this is actually defined to be the increase in the present value of defined benefit obligation as a result of the employee service during the current period. As a result of the employee service during the current period. So therefore, you're saying that this is the current service cost. We can say that this is a defined benefit obligation as a result of employee services during the current period. In other terms, or basically in very simple terms, this refers to the increase in the amount of money which an employee is required to pay in the future as a result of the services which the employee is rendering currently, or rendered during the current financial year. So the other term to be defined here is the term past service cost. When talk about the past service cost, this we say is the change. Is a change in the present value of the defined benefit obligation as a result of the changes which occurred during the current financial year as a result of the services which are rendered in the prior period. Or in very simple terms, the past service cost, this whereby, for example, an employer may decide to make an improvement. What is an improvement? An improvement is whereby the employer, for example, had promised to pay a pension to a certain employee of maybe 5 million, but because this employee has been performing very well, the performance of that particular employee is very, employer may decide to increase now the pension from maybe 5 million to something like 7 million. So that increase of the pension to be paid from 5 million to 7 million is an improvement. So as a result of that particular improvement, it is obvious that the amount of money which now an employee is expected to pay in the future will do what? Will have to change. So therefore, you can say that this is a change change in present value of defined benefit obligation as a result of an improvement which occurred the current financial year, during the current financial year. And in this case, I've said when talk about an improvement here, this whereby the employer, this whereby an employer will promise to do what? To enhance the pension. To enhance is like to increase. Maybe the employer had promised to pay a pension of 5 million, but because an employee has been performing very well, the employer decide to increase this maybe to something like 8 million. So in such a case, we say that the pension to be paid has been enhanced, or another employee is expected to pay in the future, but once the employee proceed for retirement has done what? Has increased. So that is the other term we need to define. The other term, number 9, is something called the vested benefit. Vested benefit. And vested benefit are those particular benefits which on the employees working in the company, working for the company in the future. If an employee decide to leave the company, he will be paid this particular benefit, because we are saying that these particular benefits are not conditional on future what? Employment. So we can say these are the employees benefits, which an employee is entitled to, i.e. they are not conditional. Not conditional on future employment. Not conditional on future what? On future employment, on future employment. So that is the other term basically which we need to define. Let's look on the other term, number 10, is something called the experience adjustment. Experience adjustment. When talk about the experience adjustment, this refers to those particular adjustments which are made by the employer during the current financial period as a result of the difference between the actual assumptions which were made by the employer and the actual events. So in this case, when talk about the actual assumptions, so these are those particular assumptions which are made by the employer under a defined benefit plan to help the employer in terms of estimating or in terms of determining the amount of contribution he to pay the pension which has already been what? Promised. So therefore, if there is a difference between those particular actual assumptions which were made and the actual event, then the employer may be required to make some adjustment during the current financial year. A good example of an actual assumption is whereby the employer estimates that the end will be something like 10%. That is the estimate which is made by the employer, that once he contributes a certain amount of money and that amount of money is invested by a retirement benefit scheme, then it will be able to earn a return of what? 10%. But maybe due to the prevailing economic conditions, the act 15%. So what that means is that because now the expected market rate of, or the actual market rate of return is higher than what the employer had estimated, then the employer may be required to reduce the amount of contribution he is making. So why is the employer making those particular adjustment of reducing the amount of contribution he is making? Is because there has been a change, or there is a difference between the actual assumptions which were made and the actual what? Events. And we can say that these are the adjustments made during the current period over the difference as a result of the difference between actuarial assumptions made and actual event. Those particular adjustments which will be made during the current period, because there is a difference between the actual assumptions now which were made and the actual events. We refer to those adjustments as what? The experience what? Adjustment. So therefore, those are basically some of the terms you should be in a position to define. You may come across a theory question whereby the examiner is requiring you to do what? To define any of those particular what? Terms. So I want us, we end at that particular point. Once we come back in our next session, we are going to look on the accounting aspect of the defined benefit plan and the defined contribution plan. So see you in the next session.
Greetings, candidates, and welcome to the Manifested E-Learning Forum. We continue with the topic decision making. The subject is leadership and management. In our today's session, we are going to study decision making under various environments. Decision making under various environments, like the environment of certainty, uncertainty, and environment of risk. Three things. Decision making under certainty, two, decision making under uncertainty, and decision making under environment of risk, usually taken in different types of environment. And the type of environment also influences the way the decision is made. And there are three types of environments in which decisions are made. The first one being the environment of decision-making environment. There is only one type of event that can take place, and it is very difficult to find complete certainty in most of the business decisions. So under certainty place, there is type of event that can take place. There is only one type of event that can take place. But we all know, candidates, it's very difficult to find complete certainty in most of the business decisions. However, in many routine type of decisions, almost complete certainty can be noticed. And such decisions generally are of very little significance to the success of the business. So as much as we can say that it is not easy to get certainty, a certain environment, there are certain decisions, especially the decisions that are made routinely. Under such environment, then we can say there can be, may say, high level of certainty when making such decisions. So under uncertainty, there are decisions that are made on routine, okay, the day-to-day decisions that are made periodically, routinely. In such an environment, we can say that there can be some very high level of certainty, okay, certainty. Then there is environment of uncertainty. Uncertainty. Now, candidates, in the environment of uncertainty, more than one event is likely to take place. More than one event more than one event is likely to take place, and the decision maker is, under this environment, completely in dark regarding the event that is likely to take place. Even to assign probabilities of happening of the events. And such situations generally arises in cases where happening of one event is determined by external factors. For example, the demand of a product. All right, that is an external factor. We may also think of the moves that competitors may make. You may not know with certainty what move or position that a competitor can take at the marketplace. And such situations, candidates, generally arise in cases where happening of the event is determined by external factors. So such decisions involve an element of uncertainty. One may not know what the competitor will do. One may not know what customers will do, or whether customers will buy goods or not. So the decisions that are made in such a case are made in an environment of uncertainty. Then lastly, there is the environment of risk. Environment of risk. Now, candidates, under this condition of risk, there is more than one possible event that can take place. There is more than one possible event that can take place. There is more than one possible event that can take place. However, the decision maker in this case has adequate information to assign probability to the happening based on the past experience that the decision maker may have had. And virtually, candidates, every decision in a modern enterprise is based on an interplay of a number of factors. And we know, candidates, that there are tools of analysis of such decision-making situations that have been developed, and they can be used in making decisions under risk. Such tools include decision-making trees, we have risk analysis models, we have preference theory, and so on. We can also say that the modern information systems can also help in using such techniques to make decisions under either uncertain environment of uncertainty or environment of risk. So candidates, these are three conditions under which decisions can be made. That is the condition of certainty, or the environment of certainty, environment of uncertainty, and environment of risk. And I've said when we began the lesson that decisions are taken, can be taken in different types of environment. And the type of environment also influences the way the decisions are made. And there are three main types of environments in which decisions are made: environment of certainty, environment of uncertainty, and environment of risk. So that will mark the end of our today's learning session. I'll give you one assignment. Can be made or may be made. One is uncertainty, certainty. Number two, uncertainty, and lastly, risk. This is uncertain, certain environment, and that is this environment of uncertainty and environment of risk. Thank you for tuning in today. I hope to meet you in our next session, where we continue to learn more in regard to the topic on decision making. Bye-bye. Hello and welcome, candidates. We are moving on well with the topic on leadership and strategic change. The subject is leadership and management. In today's session, we will take on a new subtopic, which is diagnosing the change context. Diagnosing the change context. Now, candidates, how change is managed is dependent on the magnitude of the challenge faced in trying to effect strategic change, and is therefore useful to consider the type of change required, number one. It's also important to consider, number two, the wider context in which change is to occur. The third thing to consider is the specific blockages to change that exist, and lastly, the forces that exist to facilitate the change process. Four important things. Number one is the type of change required. Number two, the wider context in which change is to occur, the specific blockages, and also the forces that exist to facilitate the change process. In our today's session, we're going to study the types of strategic change and how to carry out diagnosis. Now, candidates, it's also important to indicate that strategy development is normally incremental in nature. It builds on rather than fundamentally changes, or it builds on something rather than fundamentally coming in to change the status quo. So strategy development is, in most cases, incremental. And therefore, candidates, we're going to draw here a matrix that is going to help us to understand the types of strategic change. We're going to have a diagram here, and types of change, let me call it types of change. Types of change. So here on one hand, we'll have what we call extent of change. Extent of change. The extent of change. Then we're going to have nature of change. Nature of change. So here we'll have realignment, two columns, realignment and transformation. Realignment and transformation. Realignment and transformation. Then you're going to have big bang. Big bang. We are going to use this matrix to illustrate the types of change. The types of change. So we have now, candidates, the nature of change is concerned with the speed at which change happens. The nature of change is concerned with the speed at which change happens. And we have two columns here. That is incremental. Remember, we say that normally change is incremental. Then the big bang, that is, in other words, fundamental, all right? And also the extent of change, on the other hand, candidates, it is important to note something on the nature of change, that it is beneficial for change in an organization to to be incremental. And what is the reason? Because it allows time to build skills. It allows time to build maybe routines. It also allows time to change beliefs in an organization. However, it should be noted that if an organization faces a crisis or needs to change direction very fast, then the big bang is the approach to take. The big bang is approach to take. So, we will now try and see the nature of changes is concerned with the speed at which change takes place, this extent at which, the extent to which, or the speed at which change takes place. And I'm repeating a third time that normally change is incremental, and it is preferable that change should be incremental because it takes time for individuals to change beliefs, to change skills, to change routines, because with strategic change there may be need to have the employees to change their skills, to change their culture, to change their beliefs, and so on. But of crisis where change may need to be fundamental, all right? What we are calling here the big bang. The big bang. All right? The big bang. So when change is incremental and the extent of change, that adaptation. Now, candidates, adaptation is change that can be accommodated within the current culture. Adaptation, number one. Adaptation. This is change that can be accommodated within the existing culture. It is a change that can be accommodated within the current or existing culture, and it occurs incrementally. This kind of change is most common in organizations. It is done what? It is what? It's most common in organization. Then in this other matrix, we have what we call reconstruction. Reconstruction. Now, candidates, reconstruction is a type of a change that may be rapid. Number two, reconstruction. Reconstruction. This is type of change that may be rapid because of the big bang. It may be what? It may be rapid, and it may involve a good deal of upheaval in an organization, but which does not fundamentally change the culture, but does not fundamentally change organizational culture. It may be rapid, but does not fundamentally change the organization's culture. That is reconstruction. It's another type of. There is the revolution. This is we have evolution here and revolution. These are change, revolution. Number three, revolution. Revolution. Now, candidates, Revolution is change that requires rapid and major strategy as well as culture change. It is rapid and requires major strategy. It is rapid and requires major strategy. That is the revolution. All right? And this could be in circumstances where the strategy has been so bounded by the existing culture that even when environmental or competitive pressures might require fundamental changes, the organization has failed or may have failed to respond. And that might have occurred over extreme. For example, situations like takeovers, which can threaten the continued existence of the company. The fourth type of change is evolution. Evolution, number 4, evolution. Is change in strategy that requires culture change. This one requires culture change. Evolution requires culture change, but over time. Evolve requires culture change, but is not rapid. Rather, it requires time. And in some respects, this is the most challenging type of strategic change. Why? Because for many in organizations, for many people in organizations, there may be no pressing need for change. There may be no pressing need for change. That is a challenge with this kind of type of change. So candidates, that is the types of change. Remember, we are doing the organizing of the change context. The organizing of the change context. If you recall, candidates, at the beginning, I said that how change is managed will depend on the magnitude of the change faced in trying to effect strategic change. I also said that it is useful to consider the type of change required. It is useful to consider the wider context in which change is to occur. It is also important to consider the specific blockages to change and forces that can facilitate change. Then we've, in this lesson, gone ahead to explain 4 types of strategic change based on these 2 axes, that is the extent of change and the nature of change. And candidates, you've said that strategy development is often incremental rather than fundamentally change prior strategy. In most cases, companies do not come up with the totally new transformative strategies, but they build on what has existed. So the big bang or the fundamental change is less common in organizations. So in this session, we've come, and that could have implications on how change might be managed. And we say that the nature of change is concerned with the speed at which change happens. And arguably, it is beneficial for change, we've said, in an organization to be incremental because it allows employees to change culture, to change skills, to change beliefs, to change routines, and so on. But we also mentioned that if an organization faces a crisis or needs to change direction very fast, then the big bang approach is the way to go. And combining these 2, we've come up with 4 types of change. The first one being adaptation, where we've said that this is where change can be accommodated within the existing culture, adaptation. The second one is reconstruction. We say that reconstruction may be rapid, but does not fundamentally change organizational culture. The third type of change is revolution. We've said revolution is rapid and requires major strategy, whereas evolution, it requires culture change, but over a longer period of time. So thank you for attending our today's session where we discussed recognizing the change context. Thank you. God bless you. Bye-bye. Hello and welcome. I'm back so that we can continue with the subtopic on decision-making models. We said in our last session that decision-making models are approaches that one can adopt in solving problems. And we discussed one decision-making model, that is the rational decision-making model. In our today's session, we're going to focus our attention on the second decision-making model, which is known as the intuitive decision-making. Now, candidates, intuitive decisions can happen almost instantly. When a decision is made intuitively or intuitively or instinctively. And often, the intuition inherently knows which decision is going to be the best. Now, candidates, intuition is an inner in a human being, and researchers have found that an intuitive decision-making model yields good results when dealing with areas where one has experience or expertise. Intuitive, candidates, in other words, is where sometimes we normally say going by your gut or your gut feeling. And gut feeling is, according to research, less effective and efficient when you are in you are in unfamiliar circumstance. And that is because one may not have enough experience to quickly recognize patterns. So it's important maybe to use this intuitive decision-making model when one is working in an area that you are familiar with or comfortable with. And when one does not have enough experience to notice patterns yet, then another model should be considered when solving problems. That's what we can say in relation to this intuitive decision-making model. I've said this is where decisions are made instinctively. All right? The decisions are made instinctively. Decisions are made using the intuition. And I've given situations where this model can be applied. According to research, this model ought to be applied when one is handling situations that one is familiar with, where one has experience and expertise. When dealing with decisions that one does not have experience or expertise, then it's important to consider using a different model. That's why we can move on to discuss another model, which is known as number 3. Let's study the recognition primed decision-making model. the recognition prime decision making model is it has a lot in common with the intuitive decision making model. Why? Because the bounded rationality model is about doing the best that one can with the time that one has. It's not about dissecting every possible solution like we learned in rational decision-making process, where one has to come up with possible solutions or alternatives to solving the problem. No, here it's not about coming up with an elaborate plan, but trying to find something that's feasible enough to implement as quickly as possible. That's why it is it shares quite a lot with intuitive decision-making model. And here is how it works. Number one, the decision maker recognizes a pattern in the information that is available. That is number one. Then number two, the decision maker then picks a course of action and runs through that course of action in his mind. Now, the third step is then, if the action seems like it will work, then the decision maker moves forward and takes that action. And if it doesn't seem like it will work, the decision maker ditches it and starts over a new script. And like the intuitive model, the recognition primed model works best in situations where one can draw a deep experience or expertise. So you can see, candidates, the recognition primed decision model is more or less like the intuitive decision making model. And we've said that the recognition primed decision model does not follow the decision maker does not generate possible solutions to a problem, does not come up with an elaborate plan on how to solve a problem. That is the decision model that is known as recognition primed approach. So, and that marks the end of our today's lesson, where we have discussed two decision-making approaches. That is the intuitive decision-making model and the recognition primed decision making model or approach. Assignment. Two questions. Number one, highlight 3 limitations of the intuitive decision-making model. Number two, outline 3 benefits of using the recognition primed decision approach in solving problems at the workplace. Thank you for attending our today's session. Bye-bye.
Hi students, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, Lecturer for Financial Reporting and Analysis. So in this session, I want us we continue with the topic number 3, with a special focus on subtopic number 5 regarding presentation or preparation of financial statement by cooperative societies. But before you look on the financial statement which a cooperative society need to prepare at the end of the year, we need to know what is a cooperative society, why is a cooperative society formed, and so on. Now, a cooperative society basically refers to an association or an organization which is formed in order to promote the economic well-being of its members. Basically, what that means is that a cooperative society here is not formed in order to provide services or basically in order to sell some goods now to the members of the public with an objective of making profit. So meaning that a cooperative society here is actually formed in order to promote now the economic well-being of the members. So therefore you can say that a cooperative society yes, so therefore in that case you're saying that a cooperative society here will be formed will be formed in order to do what? To promote now the economic well-being of its members and not to provide services or basically to sell goods now to the members of the public in order to do what? To make profit. So mean that whenever, for example, maybe a number of individuals come together, they decide to form something like a SACCO. Basically, a SACCO is a good example of a cooperative society. And we know that those particular members will be forming that particular SACCO in order to make some savings. And if one of the member maybe require a small loan, then he can be able to come to that particular SACCO and be able to do what? To borrow that particular money. So meaning that the objective of forming that SACCO is to promote now the economic well-being, to promote now the economic welfare of who? Of the members. Now, whenever a cooperative society is to be formed, a cooperative society is formed and also registered in accordance with something called the Cooperative Societies Act. And basically, once a cooperative society has been registered in accordance with that particular act, then it is recognized as a legal entity, meaning that a cooperative society do have the same status just like a company. A cooperative society can be able to own property. It do have what we refer as a contractual capacity. It can enter into contract on its own name. It can sue or be sued. It can own property and so on. So therefore, a cooperative society do have the same status, just like what? Just like a company. It is a legal entity. Now, according to the Cooperative Societies Act, we have 3 types of cooperative societies which can be registered or which can be formed in accordance with that particular what? Act. So therefore, in this case, we can look on the different types of cooperative societies. Types of cooperative societies which may be registered in accordance with what we refer as the Cooperative Societies Act. Number 1, we have something called a primary society. A primary society. So when talk about the primary society, this refers to any cooperative society which is formed by individual members. And according to the Cooperative Societies Act, for this particular cooperative society to be formed, it must be formed by a minimum of 10 qualified persons. And actually, for a person to qualify to be a member of a cooperative society, according to the Cooperative Societies Act, such a person need to have attained the age of 18 years. Number 2 is that such a person must be a resident or basically must own land within the cooperative society's area of what? Of operation. And number 3 is that that particular person must be within the profession, within the employment within which now the cooperative society is operating. So mean that if, for example, a cooperative society is formed like a coffee farmers, for any person to qualify to be a member, then such a person must be a coffee what? A farmer. So therefore, it is important to note that primary societies are those particular cooperative societies here, which we are saying are formed by individual members. And also we are saying that according to the Cooperative Societies Act, for this particular cooperative society to be formed, it must be formed, or basically it is formed by a minimum of 10 qualified members, or basically 10 qualified persons. Number 2, we have something called the secondary cooperative society, or basically we can refer to it as the cooperative union. Cooperative union. In other terms, it can also be known as a secondary society or a secondary cooperative society. And this is a particular cooperative society which will be formed by 2 or more primary societies. So mean that members of 2 or more primary societies may come together and they decide to register now a certain cooperative society. That cooperative society now which will be registered, or basically which will be formed, then we say it is formed by a primary society. So therefore, cooperative union is that particular cooperative society which is formed by 2 or more primary societies, 2 or more primary societies. Number 3, or the other type of cooperative society is something known as the cooperative union. So when talk about the cooperative union, this refers to that particular cooperative society which is formed at the national level, basically to promote the growth and the development of what we refer as the cooperative union. So therefore, it is formed at the national level. The objective of forming this particular cooperative society is to promote the growth and the development of cooperative union. A good example of this particular cooperative society in Kenya is what we refer as KUSCO. KUSCO basically is a cooperative society which is formed at the national level to be able to promote the growth and development of cooperative union. So we can say yes, so therefore, what we refer as a cooperative union. Okay, cooperative union, we can use the word Apex Society. Let's rename this. The appropriate name for that, sorry, should be Apex Society. Apex Society, sorry for that, not cooperative union. So therefore, Apex Society, we are saying, is a particular cooperative society which will be formed at the national level to be able to promote now the growth and also the development of what we refer as the cooperative union. So therefore, according to the Cooperative Societies Act, we have those 3 types of cooperative societies which may be formed and also registered in accordance now with the Cooperative Societies Act. Now, our main focus here, as the topic suggests, is basically preparation of a financial statement of cooperative societies. And therefore, which are the financial statements which are prepared by a cooperative society? So we can look on those corporate financial statements. Financial statement prepared by cooperative societies. First of all, it is important to note here that when we talk about the financial statement, we are talking of the final accounts which are prepared by cooperative societies at the end of the year to basically ascertain their performance, to ascertain their financial position. In this case, we have 3 final accounts, 3 financial statements which are prepared by the cooperative societies, and those financial statements include, number 1, what we refer as the income statement. Statement, which is also known as a statement of profit or loss. And number 2, we have what we refer as the appropriation account. And number 3, we have a statement of financial position. statement of financial position. So these are the final accounts which any cooperative society need to prepare at the end of the year. So let's start by looking on what is an income statement and why a cooperative society need to prepare the income statement. So number one, we have the income statement, which we also referring to a statement of a profit or loss. And as the name suggests, a statement of a profit or loss, or basically what you're referring to as an income statement, this one is prepared to determine the performance of a cooperative society. So mean that in preparing the income statement or the statement of profit or loss, basically what the cooperative society will be doing is basically comparing the income of a given financial year and what if is what the expenses or the expenditures incurred during that year. Any difference between the two is actually a profit or what or a loss. So therefore you can say that this is prepared. It is prepared to ascertain financial performance. Financial performance of a cooperative society. Of a cooperative society. In other terms, we can say just prepare to ascertain the profit or loss of a cooperative society in a given financial year. So how do we prepare, or how is this statement of a profit or loss presented? So let's look on the format or the layout of what if as a statement of profit or loss. Statement of profit stroke loss. Automatically the one is prepared for a certain year. Yes, so here always we start by recording incomes of the cooperative society. Incomes of the cooperative society. A cooperative society may have various sources of incomes, including things like investment income, and we prepare this account on using vertical format. So a cooperative society may be having something like investment income, things like interest on loans to members. So whenever a cooperative society gives members loans, like a SACCO, the cooperative society, or basically the SACCO, will charge some interest. That interest is basically what? An income. So also a cooperative society may be having the other source of income like entrance fees. If you are you want to join a cooperative society, you may be required to pay some fee. So these are some of the good examples of the incomes of a cooperative society, and then from there you get incomes, the total incomes, and then out to this we proceed and less the expenditures. Less the expenditures, or basically the expenses of the cooperative society. And here we basically deduct now the expenses incurred by the cooperative society in a given financial year. This will include things like maybe salaries and wages to the staff, things like management committee allowances, So a cooperative society is managed by a top organ known as management committee. Things like what? The interest on members' deposit. Cooperative societies, mostly SACCOs, they pay interest which is based on members' deposit, because the SACCOs want to encourage members to continue saving with that SACCO. So at the end of each year, as a member, you are paid some interest which is based on your what? On your deposit. So we take into account that. Then we also take into account other expenses like rent, etc. So we take into account all the expenses of the cooperative society, and we less that now from the total income. So whatever you get here is now the profit for the year. So that's how a a statement of profit or loss or an income statement of a cooperative society is presented or is what? Prepared. So next, let's look on what is the appropriation account and why an appropriation account is prepared. Yes, number 2, we have appropriation account. Appropriation account. So as the name suggests, is this is basically an account or a final account which is prepared by cooperative societies to show how the profit for the year is supposed to be distributed to the various stakeholders. For example, this account is prepared to show how much amount was paid to the members as dividends, and also how much amount was set aside as statutory reserve fund. Now, it is important here for you to note that under the Cooperative Societies Act, cooperative societies, mostly SACCOs, are required to set aside 20% of their profit as a statutory reserve fund. So therefore, that amount which has been transferred from the profit to the statutory reserve fund, in accordance with the Cooperative Societies Act, it is also shown in this particular what? Account. And therefore, you can say that yes, so this one is prepared to show how the profit for the year was distributed to various stakeholders in form of dividend, in form of transfer to the statutory reserve fund, and so on. So how do we prepare this particular account here? So we can look on the format of the appropriation account. Appropriation account. Yes, so in preparing the appropriation account here, always we start with that particular profit for the year, which was determined after preparing now the income statement. Profit for the year, that's what we start with always. And then to this, we proceed and we less dividends which were paid. So if there are some dividends now which were paid, we come, we less those particular dividends here. We also deduct the transfer to the statutory reserve fund. Statutory reserve fund. And in this case, I've said that the statutory reserve fund, the amount to be transferred to the statutory reserve fund, this one, according to the Cooperative Societies Act, is always 20% of the profit. 20% of the profit for the year. So the examiner may have given that particular information to you, but equally, if you're given a question for cooperative society, that information still is missing, you have to note that 20% is a must, that 20% of the profit for the year must be transferred to something called the statutory reserve fund. And then after deducting those two items, what we do is that we get now the retained profit for the year. The retained profit for the year. The retained profit for the year. To this retained profit for the year, we add the retained profit balance brought down. The retained profit balance brought down. This is the profit which was retained in the previous year. And then whatever you get down here is the retained profit, which is also known as the appropriation account balance. Appropriation account balance carried down. And this particular balance which we have here, this one will be transferred to the statement of financial position as a component of equity. So this one is transferred to statement of financial position as a component of equity. as a component of what? Equity. So basically that's how the appropriation account is prepared. You can see it is basically prepared to show how now the profit for the year, the profit which was reported during the year was distributed now to the various stakeholders. Finally, I want us to look on how we prepare the statement of financial position. So number 3, statement of financial position. Now, when talk about this one, statement of financial position, formerly known as the balance sheet, this one is prepared to show the financial position of a cooperative society at the end of the year. In other terms, this is a statement of asset, liabilities, and equity, and this one always has to be prepared based on something known as the accounting equation. So we can say that this. Yes, so therefore this is a statement of cooperative societies assets, liabilities, and equity as at the end of the year. As at the end of the year. On the other hand, we can say that it is prepared based on the accounting equation. Yes, so therefore this one we prepare it based on the accounting equation. The accounting equation is an equation which states that assets are equal to capital plus liabilities, equal to capital plus liabilities. So let's look on the format, how we prepare a statement of financial position. And actually this one we abbreviated as SOFP, statement of financial position, which is prepared as at the end of the year. Prepared as at the end of the year. So always we start by recording assets. And when preparing a statement of financial position for a cooperative society, is not a must. There is no need of classifying the asset into non-current and current. Just like what the banks do, we record the asset of the cooperative society starting from those assets which are liquid. When talk about assets which are liquid, we are talking of asset in form of cash, and then followed by those assets which are highly liquid, those assets which can be converted into cash within a short period of time, and finally we record now the long-term asset like the PPE and so on. So therefore, we start by recording assets. In this case, I've said we don't classify the asset into non-current and what? Current. So when recording the asset, what is important here is you start with most liquid assets. Most liquid assets, and finally record long-term assets. So meaning that here we start by recording things like the cash and bank balance, and then next we record things like investments. We also record things like loans to members. Whenever something like a SACCO has given the members some loan, that is an asset the cooperative society expects the members to repay back those particular loan. And then you finally record the long-term asset, such as now the PPE, property, plant, and equipment. So therefore, I've said here, no need of classifying the asset into non-current and current. And then from there, get the total assets. Next, we record now the capital and the liabilities. And remember what I've said is that the cooperative society here do have the same status just like a company. So therefore, for capital, we record, or the capital, which is also known as equity. This comprises of share capital, things like members' deposits, and the reserves. So therefore, let's look on what we record under equity. So next we record equity. And equity, I've said that this comprises of share capital and what? Reserve. So we record the share capital. Share capital. We also have the members' deposits. The members' deposit. So it is important to note that if maybe the cooperative society we are dealing with is something like a SACCO, members will have made some deposit with such a SACCO. But generally, as a member of a SACCO, you can't be able to withdraw that particular amount of money anytime you want. So you can only be able to get back that particular amount of money if now you do what? You want to quit from that particular cooperative society. So mean that particular amount of money which you have deposited with your SACCO remain with the SACCO. The SACCO uses that as capital because mostly SACCOs use that money in terms of giving loans to members. And that's why you can see we are treating that as part of capital. As part of what? Capital. So we record other items of equity like the statutory reserve fund, statutory reserve fund. I've mentioned something to do with this, and then things like the appropriation account, and other reserves like the revaluation reserves, etc. Yes, so those are the various items of equity, and then get the total equity there. Get the total equity, and finally record liabilities. Equally here, when recording the liabilities of a cooperative society, no need of classifying them into non-current and also what? Current. You just record all the liabilities here, which include things like what? Things like creditors. Things like creditors, the amount of money which is owed to the creditors, any accrued expense, etc. Yes. So record all those particular liabilities there, and then proceed. You get what? The total equity and liabilities. Total equity and liabilities. And whatever you get here is the total equity and liabilities, always it must be equal to the total asset, simply because we prepare that statement of financial position based on the accounting equation which states that assets are equal to capital plus what? Liability. So therefore, that's how we prepare or basically present this particular statement of financial position of a cooperative society. So that brings us to the end of that session. In our next session, still in this on this particular subtopic here, we are going to look on an illustration question regarding presentation or preparation of financial statement of a cooperative society. So see you in the next class. Hi candidates, welcome to another session of manifested online classes. So in this session, I want we continue with the topic on impairment of asset. So in our previous class, we discussed or we defined what is an impairment. When an asset is deemed to be impaired, those particular factors which shows that the asset could be impaired. And also we did an illustration question as far as the determination of impairment loss is concerned. So in this session, I want we look on what is a cash generating unit in accordance with IS 36, and how do we determine the impairment loss of a cash generating unit, and how is such impairment loss allocated to those particular assets within a cash generating asset. So first of all, we'll talk about cash generating unit, which is abbreviated as CGU. This refers to a group of assets which generate cash flow as a group. What that means is that if you pick one of the assets from that particular group of assets, that asset cannot be able to generate cash flow on its own. A good example is something like a factory. So a factory, we know, do have a number of assets. We have the factory building. We have the machines which are installed within the factory. We also have computers maybe for record keeping. We also have some tractors which work in the factory for transporting the raw materials maybe from point A to point B and so on. So therefore, a factory is basically a cash generating unit. It's basically a group of assets which generate cash flow as what? As a group. What that means, therefore, is that if you pick one of the assets from that particular group, it cannot be able to generate cash flow on its what? On its own. As we are going to see later on, in determining now the impairment loss of a cash generating unit, we determine the impairment loss of the entire group of assets and not the impairment loss of the asset within what? Within that particular CGU. But before we do that, let's first of all define what is a cash generating unit or a CGU. And I've said that this is a smallest identifiable group of assets, assets that generate cash flows, that are largely independent from cash flows generated by other assets, or group of assets, So that is the definition of a cash generating unit. Now, what we have said is that when it comes to determining the impairment loss of this particular cash generating unit, we have said that we determine the impairment loss of the cash generating asset, not the impairment loss of individual asset within what? Such a group of assets, simply because you have said that this particular asset here, they generate cash flow as a group. And it is also important for you to recall, for you to be able to determine the impairment loss of an asset, there is something you need to determine or to compute known as the value in use. We compute the value in use or the recoverable amount of an asset using the cash flows which are generated by the asset. And due to the fact that individual assets do not generate cash flow on their own, it is not therefore possible to do what? To determine the impairment loss of individual asset within that group. But what you are saying, we determine the impairment loss of what? Of the entire cash generating asset. So therefore, we can say that it is not possible to determine a recoverable amount of individual assets, within the cash generating unit. I've explained the reason why this is the case. We are saying if, for example, we have a group of assets, we can take, for example, a factory. Factory, we have said, comprises of a number of assets. We have the machines in that factory. We also have things like the patent. The patent is that innovation used by the company in terms of producing various products. We also have things like computer equipment. We also have things like what? Motor vehicles, which work within that factory and so on. So therefore, we are saying that this is a good example of what? A cash generating unit. So this particular asset here generate cash flow as a group, meaning that if, for example, you pick one asset from this particular group, like maybe you pick something like machines, these machines cannot be able to generate cash flow on their own. And therefore, it is not possible to determine the recoverable amount of that particular what? Machine. Because for you to determine the recoverable amount of the machine, there is something which you need, and that is the cash flows generated by that machine. We are saying the machine itself cannot or do not generate cash flow on its own. The cash flow which is generated, it is generated by all these particular assets as what? As a group. That's why we are saying it is not possible to determine what? The recoverable amount of individual asset within what? The cash generating what? Unit. So instead now what we do, we determine the recoverable amount of the cash generating unit, and further we go ahead and determine the impairment loss equally of the cash generating what? Unit. So therefore we can say thus the recoverable amount of the CGU is determined which is then used in computing impairment loss, of the cash generating what? Unit. So therefore, once we have a group of assets which generate cash flow as a group, we are saying it is not possible for you to determine the impairment loss of individual asset here, but what you do, you determine the impairment loss of the group of assets. You determine the impairment loss of the cash generating unit. Now, once the impairment loss of this cash generating unit has been determined, and actually this impairment loss of a cash generating unit is determined in the same way, just like how we determine the impairment loss of individual asset. Maybe you can just remind ourselves about the on how we compute the impairment loss. So the impairment loss is equal to the carrying amount minus the recoverable amount. The recoverable amount, and equally you have to recall that the recoverable amount here, we said this is the higher over two values. Number one, the value in use, or number two, the net realizable value or fair value less cost to sell. So therefore, in terms of how we determine the impairment loss of cash generating unit, we use the same approach, the same formula for determining the impairment loss for individual what? Asset. Now, this particular impairment loss for the cash generating unit, then we are saying should be allocated to the asset within that particular cash generating unit. And in doing that particular allocation, in allocating the impairment loss, there is the order which is followed. So therefore, you can say the impairment loss for the CGU cash generating unit is allocated to the assets within the CGU in the following order. So number one, we allocate to those particular assets which are obviously impaired. Number one, to asset obviously impaired. Assets obviously impaired. And when talk about assets which are obviously impaired, these are assets which are damaged, or the assets which are destroyed, the assets which are destroyed. So basically what that means is that if the company decide to sell this particular cash generating unit, then that particular asset which is obviously impaired will not fetch any amount of money because it is damaged, or basically it is what? Destroyed. Number two, we allocate impairment loss to the goodwill in the cash generating unit or in the CGU. And number three, we allocate to other assets. allocate to other assets, to other assets, to other asset on pro rata basis, pro rata basis, i.e. based on the carrying amount, based on their carrying amount or the net book value. So any impairment loss now will be allocated to the other asset other than goodwill, other than those particular assets which are obviously impaired, and that should be done in accordance with the net book value. In this case, we have said to other asset on pro rata basis. It is also important here to know that when allocating this particular impairment loss, the value of the asset should not be reduced below the higher of these three values, below the higher of three what values. So therefore, we can say in allocating the impairment loss, in allocating impairment loss, the value of an asset should not be reduced below the higher of three values. Number one, 0. Number two, the net realizable value of the asset. And number three, the value in use if it is determinable. If it is what? Determinable. Remember, in this case, in determining the value in use of an asset, we use the cash flows. We use the cash flows. We discount the cash flows to be generated by such an asset. But we are saying assets which are within a CGU, asset which generate cash flow as a group, then it is not it is not possible to determine the cash flow generated by individual assets, because those are assets. They are generate cash flow as what? As a group. So individual asset cannot be able to generate cash flow on its own. And therefore, in most of the cases, it is not possible to determine its value in what? In use. So therefore, once you have allocated the impairment loss, then make sure that the value of the asset is not reducing below the higher of 0, net realizable value, or the value in what? In use. So therefore, that is what is important for you to know. You need to know what is a cash generating unit. How do we determine the impairment loss of the cash generating unit, and equally, how do we allocate that particular impairment loss to those particular assets within what? The cash generating unit. And basically, I've said that is the order which is followed: to the asset which have obviously impaired to the goodwill, and basically to the other what? Asset in that cash generating unit on a pro rata basis. So I want us to do an illustration as far as this is concerned, and the illustration question I want us to do is a question which was tested in the sitting of August of 2022, and then at the end of this lesson, I will give some assignment on the same. So let's look on that question. So this is a question for August of 2022. Question number 2A. So the question is, B Limited operate a factory as its sole cash generating unit. During the year which ended 30th of April 2022, there was an explosion in the factory which necessitated an impairment review. So basically what that means that at the end of the year 2022, there was some evidence which showed that this cash generating unit could be impaired, and therefore there was a need to carry out impairment review. So we are given the carrying amount of the factory asset, which were as follows. So we have goodwill, and the carrying amount was 2 million, patent 3.6 million, machine 4 million, computer equipment 8 million, premises 30 million. The total carrying amount is 47.6 million. Then we have some additional information. Number one, we are told an impairment review or an impairment review revealed a net selling price of shillings 19.2 million and a value in use of 31.2 for the factory. 2, half of the machine have been destroyed and have no resale value. Number 3, the patents have been superseded and are now considered valueless. And number 4, we are told the company follow the cost model as permitted by International Accounting Standard number 16, that is which deals with the PPE. So what that means that the property, plant and equipment which are owned by this company, they are accounted for using the cost model. Remember what you have said is that if the company is accounting for its assets using the cost model, then the full amount of impairment loss should be deducted from the value of the asset. Should be deducted from the value of the asset. That is the implication or basically the importance of that particular point. So what you're required is to discuss with suitable calculations how any impairment loss in the cash generating unit CGU would be accounted for in accordance with what? International Accounting Standard number 36. So we are required to discuss with suitable calculations. So basically what you needed to say here is that this company, that is B Limited, will need to carry out impairment review, or basically we need to determine the impairment loss of this cash generating unit and then proceed to allocate it to the asset within that particular cash generating unit. And actually we have discussed on the order to be followed by the company in allocating that particular impairment loss. So therefore, before we can determine the impairment loss, we can say that on 30th of April 2022, which is now the end of the year, B Limited must do what? Must carry out impairment review and any impairment loss should be allocated to the asset within the CGU, within the cash generating unit in the following order. In the following order, one, we have said impairment loss should be allocated to assets which are obviously impaired. Number 2, we allocate to the goodwill within that cash generating unit. And finally, to other assets on pro rata basis. On pro rata basis means that when allocating now the impairment loss to the other asset within the CGU, we allocate that particular impairment loss based on the net book value of the other assets. The net book value, remember, is the same with what? The carrying amount. That's the first thing you needed to say. And then from there, you proceed, you determine the impairment loss. For you to do that, you must have the formula of determining the impairment loss, which is the carrying amount minus recoverable amount. So we need to have these two values, carrying amount and the recoverable amount of the cash generating unit. So the carrying amount, remember, is the same with the net book value because the examiner may give you the net book value instead of the carrying amount. And we already given that amount under paragraph 2 of this cash generating unit, which is given as 47,600 million. So that figure is already given. Then we have that, we need next to determine the recoverable amount. And the recoverable amount, we have said that this is taken to be the higher, or we take this to be the higher of two values. Number one, the value in use, of which the value in use is given in the addition information number 1. We are told the value in use was 200 million. 200 million shillings. 200 million. So we take that all Roman 2, the net realizable value. The net realizable value in other terms is the fair value less cost to sell. And this is what in the addition information number 1 is given as the net selling price. The net selling what? Price. Because when talk about the net selling price, this is the amount now which the company will receive after selling the asset minus any cost which will be incurred by the company in selling that what? Asset. And this is given as 19,200 million. 19,200 million. So what we need to do, out of the two figures, we need to take the figure which is higher. Automatically that will be that 1.2 million, and that will be the recoverable amount. So therefore you can say our recoverable amount is shillings 31,200 million. 200 million. So having this value here, having the recoverable amount and the carrying amount, so what we need to do is to determine whether our cash generating unit is impaired. Remember, generally we have said an asset or even a cash generating unit will be deemed to be impaired when the recoverable amount is less than the carrying amount. So in our case, we know the recoverable amount is 31,200 million. What about the carrying amount? It is 47,600 million. So we need to check, is our recoverable amount less? Is this less than that one? Yes, it is. If that is the case, then we say that our asset here is what? Is impaired. Not the asset, rather, our cash generating unit is what? Is impaired. And therefore, what we need to do, we need to proceed and we determine the impairment loss. The impairment loss, we use our formula up here. We take the carrying amount, which is 47,600 million, minus the recoverable amount, which we already have here, 31,200 million. So we get the difference here, which now will be what? Which will be the impairment loss. So we have 47,600 minus 31,200. Okay, we can take that again. 47,600 minus 31,200. So that will give us impairment loss of shillings 16,400 million. 400 million. So what we need to do now is to proceed and allocate this impairment loss to the asset within that particular cash generating unit. So we need to do the allocation of that impairment loss. So we have allocation of impairment loss. Allocation of impairment loss. So remember what we said is that in allocating this particular impairment loss, this is the order which we follow. 1, we allocate to those assets which are obviously impaired. Then we allocate to the goodwill. And finally, we allocate to the other asset based on their carrying amount. So there is some information which you are given in this particular question here. Let's go to the additional information number 2. We are told half of the machine have been destroyed and therefore they have no resale value. So any asset which do not have a resale value, such asset is obviously impaired. Is obviously impaired because you have said assets which are obviously impaired are those assets which are destroyed, or basically those assets which are fully damaged. So therefore, number one, we are going to allocate to machine, and basically not all the machine. We are told half of the machine. Half of the machine. And if you go back to the information we have under paragraph 2, the machine have a carrying amount of 4 million. 4 million. 4 million. It is important to note that these figures here are in thousand of shillings. These figures are in thousand of shillings. So therefore, these will not necessarily be millions. Yes, because our figures are in thousand of shillings. Yes, so let's do away with the million here. Let's do away with the million here. Yes, but we need to know all our figures here are in thousand of what? In thousand of shillings. Yes. So first of all, you're going to allocate to the machines, not all the machines, but half. So machines, they have a value of 4 million. So what is half of 4 million? Half of 4 million is 2 million. So therefore, because those machines are fully impaired, we are going to allocate an impairment loss equivalent to their carrying amount, which is 2 million, such that once you have allocated that impairment loss of 2 million, we are going to reduce the carrying amount of 2 million with 2 million. And that means that the value of those machines after allocating the impairment loss will be zero. Will be what? Zero. So basically, it means that the other machines, and that is half of the other machines, or half of 4 million, those machines are not obviously impaired. So then there is also another information we have in note number 3, that patent, which is one of the assets within that CGU, have been superseded and are now considered valueless. So when talk about patent, a patent is basically an innovation which is used in the factory in terms of producing various products. So if you are told it is superseded, it means that it has been replaced by a new patent, and therefore it is considered to be valueless, meaning that such asset is also considered to be fully what? Impaired. So if the company decides to sell this CGU, that patent will not fetch any amount of money. So therefore, next we allocate to the other asset which is obviously impaired, and that is what? Patent. And in this case, we are going to allocate impairment loss of how much? That is 6. Remember, our total impairment loss is 16.4. So therefore, in allocating this impairment loss, always you must remember how much is the impairment loss. You can see to this machine, we have allocated impairment loss of 2 million. So meaning that out of the total impairment loss, we have an impairment loss which is remaining of 14.4. So we then allocate now an impairment loss to patent of how much? That is 6. Still, our impairment loss is remaining. Then we have allocated now to the assets which are obviously impaired. So these are assets obviously impaired. So next, we allocate now to the goodwill. Within that cash generating asset. So the value of goodwill is what? Is 2 million. Can we be able to allocate a full amount of 2 million? Yes, because remember our impairment loss 16.4. To the machine, we have allocated 2 million. To the patent, we have allocated what? That is 6. So mean that the remaining impairment loss is in excess of 10 million. So therefore, to the goodwill, we are going to allocate the full amount of what? 2 million. Yes, so that is goodwill. And then finally, we allocate now to the other asset within that CGU. So which are those other assets? We can just list them here. Other assets. These include, from the list which you have provided under paragraph 2, we have allocated to the goodwill, we have allocated impairment loss to the patent, and then we have now the machine. We can talk of the other machines. Remember, the machines which were fully impaired here were half. So the other machines will be having a net book value of what? A net book value of 2 million, or a carrying amount of 2 million. So and then below that, we have computer equipment. We have not allocated any impairment loss to those computer equipment. The net book value or carrying amount is what? Is 8. and then we have a premises. A premises whose value is 30. So mean that the total carrying amount of these three assets is what? Is 40. So why do we need this particular value here? We need that particular value because we are going to allocate now the remaining impairment loss to those three assets based on their carrying what? Based on their carrying amount. So therefore, what we need to do, we need to determine the impairment loss now to be allocated to these three assets. So how do we determine that? So the first thing we need to do is to determine how much impairment loss was allocated to machine, or the total impairment loss allocated to this machine which were destroyed, patent and what? And goodwill. And this will give us 4 million, meaning that that will come to a total of 36 plus 4,000. That will come to a total of what? Of 76. So mean that the total impairment loss which is here to be allocated will be equal to the total impairment loss minus the impairment loss which has been allocated to these three assets, 76, and the remaining impairment loss will be what? Will be 800. So, or 8.8. So this impairment loss will be allocated to these three assets based on their net book value, based on their carrying amount. So to determine the amount to be allocated to other machines, we take its carrying amount, which is 2 million, all over the total impairment, all over the total carrying amount of the three assets, which is 40 million, times the impairment loss to be allocated to the three assets. We do the same for computer equipment, 8 million, all over the total impairment, all over the total carrying amount, 40 million, times 800, and finally to premises, 30 million, all over 40 million times 800. So this will give us the impairment loss to be allocated to those three assets. So to the other machine, we have 2 out of 40 times 800, and that will give us for 40. Remember also these figures are in thousands of shillings. What about to computer equipment? We have 8 all over 40 times 88, and that will give us 1760. And then finally to what? To premises, 30 divided by 40 times 800. So which will give us 66. So that is now the impairment loss to be allocated to other machines, computer equipment, and the premises. So that is it. That basically what was required as far as that particular question was concerned. And basically by determining this particular impairment loss, and then proceeding to allocate it now to these other assets, then by doing that, you could have gotten now the allocated 10 what? 10 marks. So that brings us now to the end of that particular topic regarding the determination of impairment loss in accordance with the International Accounting Standard number 36. But before we end our class, I want to give some assignment. These are some questions from the past papers. Make sure you attempt those questions. We have 2 other questions on this. So the first question is for September 2021, question 5B. So this question was requiring the computation of impairment loss for 2 cash generating units. And then we have another question for December 2023, which is question number 1C. Question number 1C. So make sure you attempt those 2 questions. 2 questions. And equally, if you have a challenge in terms of answering those questions, I always usually encourage my students to acquire this revision partner. All those particular questions are here. The questions are here, and also the solutions for those particular questions are at the end of this particular book. So if you have a challenge in terms of answering those particular questions, make sure you get this revision partner, which is basically available at a very affordable rate. So therefore, we come to an end, or basically that is the end of that particular session. So see you in the next class as we look on the other subtopic.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Ningwiri, and today, ladies and gentlemen, we are discussing about the business data analytics, December 2023, question 22. It reads as follows: Safari Limited is evaluating a project with the following details. You've been given the initial investment, 100 million, residual value, 10 million, year one projected project cash flows is 25 million, the annual cash flow growth rate from year 2 is 10 million, the project life is 5 years. You are required: A, compute the following project metrics: payback period, number 1, number 2, the net present value, assume a discount rate of 12%, number 3, the profitability index, assume a discount rate of 12%. B, using a graph, determine the project's internal rate of return, and this totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. And this solution over here, I can just drag this one down over here. This is A, and this gives us year. So we have the years given to us. They're from year 0, 1, 2, and of course you know what happens. Once you put it like this and then you have that plus sign like that, you can drag it up to the number of years you actually want like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5. And you can be able to see the project life right over here is 5 years. So from year 0. And we are saying from there, then we need then to put the value over here. We're dealing with Kenya shillings, so shillings, put shillings, and we are saying we can put them in thousands. That all of these need to be put in terms of thousands over here. That why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable figures. And from there, we can put over here the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because you're saying that we are expressing it in terms of thousands over here. Yes, it's 100 million, but if you remove those 3 zeros there, we're saying we're dealing with 100,000. And because we want to deal with values that are in terms of the accounting format, so let's put it like that, then just do it sort of something like that. That looks at least well presentable, I mean. So initial investment is that. Then we have the residue value or residual value. That. And the residual value is assuming that you sell the asset at the end of the project or after 5 years there. So right here I can put over here in terms of the residue value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the net cash flows over here, the cash flows. cash flows. And you're seeing the cash flows over here we've been given. The initial investment is 100 million. You're seeing the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment, we can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter, it can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we're seeing is 25,000. Not right there, you can put, because this is the residual value, the cash flows here, 25,000. That, and we're saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that, and we make sure at least it auto fits within the cells. So from there, we are saying that what is going to be our net cash flows? Our net cash flows are going to be as follows. Flows. Then, so here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, just going to pick the residual value plus the cash flow itself over here, if any. So that now after period 5, we expect this cash flow to be 46,603 over here to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here I can write now the payback period. Because that's what you're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that, and we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here it's just going to be that value, and then we're going to pick plus that value plus this net cash flow here, comes to 75, and then we reduce it. We continue, we drag it because it's got a formula. We continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period over here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. Like that. So 6.22 months. So the payback period you can see is, we can say, is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing part A, part 1. So this is A, part 1. I can just put it like so. This is A, part 2. A, part 2. Like that. So that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones the way they are like that. Copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this. Copy, put it just down here like so. And this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we pick it from above here. That's the initial investment there. No problem. The residual value, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we're linking it like that. And we're saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows like that. And then we have this value like that. And this is what we're going to discount. These ones over here. These net cash flows. You see, like the way I've did over here, the relevant values, these are the ones which are going to, we're going to discount and get the present values right over here. So present values, so the present values will be, we're going to get this value over 1 plus R over here. But for us to be able to get the present values, or there's in Excel, there's always a way we can be able to get the present values. Always. There's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus the discount rate power 1, this value over 1 plus the discount rate power 2, power 3, power 4, and power 5 like that, we can just go to the to a formula NPV like that, and we are saying we open it up right here and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there, like that. That's the initial cash outlay. So that's what we are saying we are going to have. 13 million, of course, because we're dealing with millions, 13,365,099. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability index. The NPV, before we move on to the profitability index, the NPV is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here part 3, I can move ahead right down here and now click this one to be 3, the third one. That. A part 3. We talk about profitability index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it right maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way, put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here. That. So these represent the net cash flows. So this is what we're saying is shillings. So we just delete this and it's okay. But the initial investment picks from here. The net cash flows. That value there. So once we have that, then we can be able to get the profitability index. And the profitability index, we are going to get present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV. See here, double click it. Then we open it up right here. And you see the rate is 12%. And then with 12%, we can put in the values over here, like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0 is where we are saying our project's IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return. The internal rate of return, IRR, is going to be, we open it up right over here, the values. So we put the values right over here, all of the values, including the negative value here. And we say, okay. So it's around 17%. And that's what we expect, or 16.75%. That's what we expect from using the graph, around there about. So he picks arbitrary rates, so 12%. You can put 12% over here. 13%, like that, and so on and so forth, like that. So we just drag it. So we can just get arbitrary rates over here, and we get the corresponding NPVs. So NPV over here, 12%. The rate is 12%. You can see from right over here, 12%. The values over here are these ones here, the net cash flows here, like that. And then we do what? We add the initial cash outlay. The initial cash outlay in this case was negative here, that, and we get that value. So it's the same as what we got above over here. That's fine. But because we want to ensure that we want to get the corresponding NPVs at different rates over here, I need to lock the formulas over here. So I press F4 there. I click over here, I press F4, and I press F4 over here, so that I can be able to lock and ensure that everything is okay. So if I drag my formula over here, it should be able to work. So that's what I'm going to do right here. So shift, Control D. But it's picking 13%, or it's because I didn't change. You see, it's still at 12% here. So what I'll do, I'll just change this to 13%, 14%, like that. 14%, 15%, and so on and so forth. Just come and change here. 16%. 17. That then 18. So don't worry about that. 19. Then here we got 20%. 20%. Like that. So you plot a graph over here. This is the NPV. NPV, that rate. Like that. So just sort of put it center to make it look presentable, and like that. Then you can just draw a graph here. Insert. Then you come to recommended charts, and you can be able to see, based on this graph over here, that point, okay, just place it somewhere right here, that at around 16% over here, you can see at around this point here, if you click right here, it will give you the point. At around 17% is when you're going to get negative NPV thereabout. 17%. And you can see it's 16.75 right here. So the exact rate should actually be somewhere over here where it's next to. It's along just this curve over here. It cuts it along this axis over here like that. NPV indeed is at 16.75. So once you draw the graph like this, it should be able to, and then you just highlight like this, you can be able to see thereabouts around approximately 17%. You can be able to get the IRR. So ladies and gentlemen, this brings us to the end of the class. We have done question 22 of the Business and Data Analytics paper, which came in December 2023. Hope you have enjoyed it. God bless you all. Bye bye.
Hi candidates, welcome to Manifested Online classes. My name is Joseph Kimani, your lecturer for advanced financial reporting and analysis. So in this session, I want us we start with the topic number 1 of AFRA, Advanced Financial Reporting and Analysis. And this topic, topic 1, is accounting for asset and liabilities. And therefore, what is expected of us as far as this topic is concerned is we look on how various items of asset and liabilities are recognized and also measured in accordance with the various accounting standards and also various international financial reporting standards. And therefore, in this topic 1, we have we have 8 subtopics. So in subtopic 1, we are expected to cover items of asset and liabilities which were covered in financial accounting and financial reporting and analysis paper. And as far as those items are concerned, we're going to look on 2 items of asset which I have highlighted here. One of it is PP. We're going to look on the measurement and recognition of a PP, that is property, plant and equipment, in accordance with the International Accounting Standard number 16. And also we are going to look on inventories, the recognition and measurement of inventories in accordance with the International Accounting Standard number 2. In subtopic number 2, we are going to look on accounting for leases. Equally, this is a topic which was covered in financial reporting and analysis in the intermediate level. But at this level, we are going to look on an additional concept which was not covered in the intermediate level, on something called the sales leaseback, and also something called the dealer in what refers the leased asset. In subtopic number 3, we are going to look on accounting for deferred tax. And in this case, we are going to look on how the deferred taxes are accounted for by companies, or basically by individual companies, and also how deferred tax is accounted for from a group point of view. So we're going to look on the accounting for that in accordance with the International Accounting Standard number 12. In subtopic number 4, we're going to look on what are employees benefits, the various types of employees benefits, and also the accounting for something called the post-employment benefits in accordance with the revised International Accounting Standard number 19. In subtopic number 5, we are going to look on the accounting of the share-based payment, whereby we are going to define what is a share-based payment, and we look on the various types of the share-based payment and how they are recognized, and also how they are measured and recognized in the company's books of account in accordance with the IFRS 2, International Financial Reporting Standard number 2. And in subtopic number 6, we are going to look on still another topic which was covered in the FRA, Financial Reporting and Analysis Intermediate level, about accounting for financial asset and liabilities in accordance with the International Financial Reporting Standard number 9. Then from there we have subtopic number 7, which is about the fair value measurement. We are going to look on how the fair value of various items of asset is measured, and then from there finally we are going to look on accounting for, or basically the measurement and recognition of impairment of assets in accordance with the International Accounting Standard number 36. So therefore, those are some of the subtopics we are going to cover. Actually, there are 8, and in each and every topic there, or subtopic, we're going to look on, or basically we're going to have some summarized notes on the same. We're going to look on some illustration questions from the past papers, and equally once we are through with each topic, I'll be giving some assignment from the Kasneb past papers, which I expect you to attempt. So I want us to start with the subtopic number 1, which is about accounting for various items of asset and liabilities, which were covered in financial accounting and financial reporting and analysis. So we're going to look on 2 items of assets, which I have highlighted here. One of it is the PPE, and also number 2, we have inventories, how they are measured and also recognized in accordance with the International Accounting Standard number 2. So let's start with the first item of asset here, which is property, plant, and equipment, abbreviated as PPE, and these are accounted and also recognized in accordance with the International Accounting Standard number 16. So first of all, what is the PPE? When talk about PPE generally, this refers to all the tangible and current assets which are owned by the entity and which do have a number of characteristics, or basically a number of features. Number 1, these particular assets are expected to be used in an organization, or basically in an entity, for a period of more than 1 financial year. And number 2, these particular assets are acquired by an entity, 1, to be used in terms of providing services, or in production of goods, or for administration purpose. So mean that if, for example, the company maybe construct a building which will be used as administration block, maybe the company acquire a motor vehicle, for example, which will be used in terms of providing the services which the company do provide. All those will be good examples of what? The PPE. The good will be good examples of property, plant, and equipment. So therefore, we can start by defining this, and we say that these are intangible assets, or basically tangible, not intangible. These are tangible assets, tangible asset with the following characteristics. With the following characteristics. Number 1, we have said that they are expected to be used to be used in a business entity for a period of more than one financial year, for a period of more than 1 year, for a period of 1 year. So mean that all the PP are expected to be used in a business for a period exceeding one financial year. Number 2 is that these particular assets are held by an entity for production of goods or provision of services or for administration purpose. So therefore, in that case, we can say that those are the two characteristics of what we refer as a PP. They are asset expected to be used for a period exceeding one financial year. These particular assets are used for administration purpose. Is there a building which is constructed by the company and which is to be used as administration block, or they are used in terms of production of goods or provision of what? Services, provision of services. Then from there we can look on the conditions for recognition of PPE. So remember, in this case we are saying PPE, these are tangible non-current assets, and therefore for any item of PPE to be recognized in the company's books of account and also in the statement of financial position as an asset, it must meet two conditions. One of the conditions is that the cost of such an asset, the cost of the asset, or basically the cost of the PPE should be measured reliably. Meaning that for any item of PPE to be recognized, then the company should be in a position to measure its cost reliably. Number 2, we say that it is probable that future economic benefits will flow into the entity and which are associated with what? With that asset. So therefore, if an item of PP meets those two conditions, its cost can be measured reliably, and it is probable that such an asset will generate some economic benefit, then we are saying it should be recognized as what? As an asset. So how are these items of PPE measured? So in this case, we're going to look on something called the initial measurement. Once the company acquire an item of PPE, that asset should be recorded in the company's books of account at which cost, and also we look on something called the subsequent measurement. So therefore, let's start with the initial measurement. We can also refer to this as initial recognition. And basically, in this case, I've said that when talk about the initial recognition of an asset, we are talking of the value at which an asset is, or the value at which an item of PP should be recorded in the company's books of account. So, and these items of PP which have been acquired by the entity, they should be recorded or they should be recognized at their cost. So this particular cost will include what? This will include the purchase cost, or in other terms, the purchase the purchase price. The purchase price is basically the price at which an asset has been acquired at. If the company acquire a motor vehicle at a cost of 2 million, or maybe at a price of 2 million, that is now the purchase the purchase price plus any associated cost. plus any associated what? Associated cost, e.g. What refers the delivery cost. The delivery cost, if the company, for example, incur maybe a machine which has to be transported from point A to point B, and the company incurs some transport cost or some delivery cost, that will also be added to the purchase price. This will also include things like the installation cost, cost, etc. So therefore, all those particular costs which are associated with acquiring an asset and also bringing the asset to its present location, they should all of them be added to the purchase the purchase price. So therefore, according to International Accounting Standard number 16, anytime the company acquire an item of PP, it should initially be recorded in the company's books of account at what it cost, and you have said that the cost includes the purchase price plus all these other costs. Then from there we have subsequent measurement. And in this case, when we talk about the subsequent measurement of an item of PP, we are talking of how items of PP should then be measured at the end of each year. According to this standard here, that is International Accounting Standard number 16, the company can use two models of measuring these items of PP, and therefore you can say two models can be used. Two models can be used by an entity to determine the value of an item of PP to be recorded in the statement of financial position. So which are those two models? Number one, we have the cost model. And number two, we have the revaluation model. So under the first model here, which is the cost model, the asset will be recorded in the statement of financial position, at the end of each year at their cost minus any accumulated depreciation minus any impairment loss. And then under the other model here, which is the revaluation model, the items of PP will be recorded in the company statement of financial position at the revalued amount. So basically what that means is that if the company has adopted this particular model here, at the end of each year, an entity will be expected to engage a professional valuer who will be able to determine the value of the asset, the fair value or the market value of the asset at the end of each year. So therefore, we have those two models which may be used by the company to do what? To determine the value at which now an asset will be recorded in the statement of financial position. And then from there, we can look on something to do with the depreciation. And basically, when we talk about the depreciation of the asset, this we can say is the estimated loss of money value of PPE. So definitely what we know is that this tangible and current asset, due to passage of time and so on, this particular asset tend to lose value. So therefore, an entity at the end of each year is expected to estimate the loss of money value of what? Of asset. And whenever an entity is doing that, there are two main methods which can be used to do what? To estimate the depreciation, of assets. And those two methods include, number one, the straight line method. So under this particular method here, straight line method, the depreciation of the asset is computed based on the cost. Computed based on what? On the cost. What that means is that for you to compute the depreciation of one entity, to compute the depreciation of the asset under this method, then always you'll have been given the rate of depreciation, and then you multiply that with what? With the cost. Then we have the other method, which is known as the reducing balance method. So under this particular method here, the depreciation of item of PP is computed based on their net book value. We know that net book value is actually the cost minus accumulated what? Depreciation. So therefore, to determine the depreciation per annum, you take the rate which is given to you times what? The net book value. So therefore, those are the two main methods which can be adopted or which can be used by the company to do what? To estimate the depreciation. To estimate the depreciation or the loss of money value of non-current asset. Finally, let's look on something to do with the recognition. The recognition of PPE. So generally speaking, when talk about the recognition of an asset, this is a process through which an asset which was previously recognized will be removed from the company's statement of financial position. So therefore, the recognition is the removal of previously recognized item of PPE from entities statement of financial position. Entities statement of financial position. So in this case, we have two criteria for the recognizing. We can talk of criteria, or in other terms, we can talk of why should a company recognize, or basically why should a company remove an asset from its books of accounts or from its statement of financial position. One is on disposal, or basically on sale. So once an asset has been sold, in other terms, once the asset has been disposed, it is obvious that the company cannot continue recording it in its statement of financial position, simply because the company is not deriving any economic benefit from that what? Asset. The asset has already been sold. Number two is that an asset should also be recognized when no future economic benefit, benefits are expected from the asset. So basically, this means that maybe the asset is fully depreciated. And therefore there is no future economic benefit the company expects to receive from that particular what? Asset. Remember here, we have talked about two conditions which must be met by an item of PP to be recognized in the company's books of account and financial statement. And we said one of it is that such an asset must be, or it is probable that such an asset will generate some future cash flows, or it is probable that future economic benefit will flow into the entity from such an asset. And therefore, if there is no future economic benefit expected from the asset, automatically such an asset should be what? Should be recognized, should be removed from the company's statement of financial what? Position. So therefore, as far as the first item of this first item of asset is concerned, and which was covered in CPA foundation level and also CPA intermediate level is concerned, those are some of the issues you need to know. Definition of a PPE, the conditions for recognizing PPE, the initial measurement and also the subsequent measurement, depreciation, and something to do with what? The recognition. I want us we finally look on the last item of assets, and that is international, or that is inventory. Inventories. So when talk about the inventories generally, this refers now to those particular goods or In other terms, these refer to those particular assets which are held by the business in the ordinary course of business. Any asset which is held by the business in the ordinary course of business is an inventory. A good example of this is what refer as the goods which are bought and which are meant for resale. So therefore, we can say that inventory, these are assets. These are assets are held in the ordinary course of business, or to be used in production process, process. And therefore, this include goods meant for resale, goods held for resale, and this will also include raw materials. This will include raw materials which are held by an entity for them to be converted to finished goods. So therefore, that is the definition of inventory. On the other hand, we need to know how the value of the inventory should be determined in accordance with the International Accounting Standard number 2. Therefore, you can look on the measurement of inventory. Measurement of inventory. And according to the International Accounting Standard number 2, inventory should be measured. Inventory should be measured at the role of two values. At the role of two values. Number one, the cost of the inventory, or number two, the net realizable value. Net realizable value. And in this case, when we talk about the net realizable value of the inventory, we are talking of the fair value. The fair value. Basically, the fair value is the estimated selling price of inventory, and then to this we less the cost to sell. So the cost to sell refers to that particular cost which will be incurred by the entity in order to sell some items of inventory. So therefore, the value for the inventory always should be taken to be the lower of the cost and net realizable value. So I think as far as the inventory is concerned, that's what you need to know. And also, as far as the PP is concerned, that's what you need to know. So I want to give some assignment here. Some assignment from the past papers. So we have the first question here, which was tested in the sitting of December 2022. December 2022. This was question number 1A. We also have another question which was tested in the sitting of this is a sitting for May 2021, and this was question number 4A. Question 4A. So you look on those two questions. So the first question was on PPE, and the other question was regarding the valuation of what? Of inventory. So basically that brings us now to the end of that session. Once we meet in our next session, we're going to move to subtopic number 2, where we are going to look on how we account for another item of asset. So therefore, see you in the next session.
Hello and welcome to the introduction of a new chapter in Public Sector Governance, Policy and Administration. The chapter is Management of Public Enterprises. This chapter has 10 subtopics. 1. Theoretical foundations of public enterprises. 2. State market debate. 3. Typology of public enterprises. 4. organization and governance structure. 5, regulatory and legal framework of public enterprises. 6, public investment appraisal. 7, relationship between government agencies and private firms in the marketplace. 8, performance of public enterprises across sectors and countries. 9, reform of public enterprises including privatization and divestiture. And lastly, public-private partnerships. Today we begin with the theoretical foundations of public enterprises. Theoretical foundations of public enterprises. In this lesson, we are going to study the rationale of public-owned enterprises, and we will also outline the theoretical models justifying public enterprises intervention. So by the end of this lesson, you'll be able to achieve the two objectives. One, to highlight the rationale of public ownership of enterprises. Number two, the theoretical models justifying public enterprises intervention. But let's begin by defining public enterprises. What are public enterprises? Now, public enterprises are also known as state-owned enterprises, the SOEs, state-owned enterprises, and they are businesses that are owned by the government. They play a significant role in many economies, particularly in developing countries, and are rooted in various economic and social considerations. That's why our first subtopic in studying the theoretical foundations of public enterprises is to analyze the rationale for ownership of public enterprises. Rationale for public ownership of enterprises. Rationale for ownership of public enterprises, established to address market failures or situations where the private sector fails to provide essential goods or services, and that can occur due to A, national monopolies that may arise as a result of national monopolies. This is where there is high fixed costs or economies of scale that make it inefficient to have multiple providers like utilities, like railway, and so on. Another reason is public goods. Public goods. Public goods. Goods that are, these are goods that are non-excludable and non-ralvirus. All right? These are goods that are non-excludable, meaning that once provided, it's difficult to exclude anyone from using them. Public goods. And one person's use does not diminish another's use, like street lighting, like defense, right? National defense. Those are goods that are non-excludable. Non-excludable. All right? You understand? One person's use does not diminish another person's use. So the market may fail, or the private sector may fail to provide such goods. That's why there is rationale or the reason the government should own these public enterprises. There is also the issue of externalities. Externalities. Now, when the production or consumption of a good or service affects third parties that are not involved in the transaction, e.g., pollution or from a factory, then we say that is an example of an externality. And because of externalities, then we have the rationale for ownership of public enterprises. Another rationale is equity and social welfare. Equity and social welfare. Now, public enterprises can be used to promote social welfare and equity by providing essential services at affordable prices, ensuring universal access, and addressing distribution concerns. That's why the government may want to own some enterprises in order to cater for social welfare and provide for goods equitably. 3, another rationale is strategic industries. Strategic industries. Governments may establish public enterprises in strategic sectors like energy, like telecommunications. Those are strategic industries. Transportation, and so on, in order to ensure national security and also control over critical resources, or even to promote industrial development. In order to promote industrial development. That is another rationale for government ownership of these public enterprises. The fourth rationale, economic development. Economic development. Now, public enterprises can play a crucial role in promoting economic development by investing in infrastructure, by creating jobs, and also fostering technological innovation. So these are 4 reasons why the government may want to take ownership of certain, what we are calling public enterprises. So let's move on to the other aspect of this lesson, which is the theoretical model justifying public enterprise intervention. Theoretical models justifying public enterprise intervention. Now, the first model is the welfare economics. 1, welfare economics. Now, this theory emphasizes the role of government in correcting market failures and maximizing social welfare. And public enterprises are seen as a tool to achieve this goal, social welfare. 2 is public choice theory. Public choice theory. The public choice theory examines the behavior of government actors and how they make decisions It highlights the potential for public enterprises to be influenced by political interests and rent-seeking behavior. Public choice theory examines the behavior of government actors like the politicians and how they make decisions. The theory highlights the potential for public enterprises to be influenced by political interests and rent-seeking behavior. 3, we have the property rights theory. The property rights theory focuses on the importance of well-defined property rights for efficient resource allocation. And public enterprises can be justified when private property rights are difficult to establish or enforce, such as the case of the natural resources. Another theoretical model or theory is the development state model. Development state model. The development state model. This model emphasizes the role of the state in actively promoting economic development through strategic interventions, including the establishment of public enterprises in key areas. So these are some of the theoretical models justifying public enterprise intervention. Welfare economics, public choice theory, property rights theory, and development state model or theory. Now, I have some questions for your homework. Question 1. What are the main economic theories that justify the existence and operation of public enterprises? And how do they explain the role of the state in the economy? 2. How does the concept of market failure relate to the establishment of public enterprises? Provide examples of market failures that public enterprises might address. 3. What are the potential advantages and disadvantages of public ownership enterprises compared to private ownership? Consider factors like efficiency, equity, and accountability. 4. How can the performance of public enterprises be effectively measured and evaluated to ensure they are fulfilling their intended objectives? Thank you for attending this lesson. In the next session, we are going to consider the state market debate. Bye. Hi there and welcome to the lesson. We continue with the topic management of public enterprises. Today we delve into the state market debate, and this debate revolves around the appropriate role of government in the economy. Revolves around the appropriate level of government involvement in the economy. The state market debate revolves around the appropriate level of government involvement in the economy, particularly concerning the ownership and management of enterprises. All right? That is what the state market debate is all about. What is the appropriate level of government in the economy? What is the appropriate role of the government or the state versus the market in managing economic activities and promoting development? That is the question. And there are very many schools of thought around this debate. That is what we are going to discuss briefly in our today's lesson. But let us first begin by outlining the key arguments in the debate, beginning with arguments for state intervention. What are the arguments for state intervention? Arguments for state intervention. Arguments for state intervention. Remember, candidates, there are those who argue for state intervention, and some schools of thought argue for the market solutions. So what are the arguments for the state intervention in the economy, particularly when it comes to the ownership and management of enterprises? The first argument for state intervention, arguments for state intervention is market failures. One, market failure. Market failure. Now, markets often fail to allocate resources efficiently, leading to externalities like pollution, public goods under provision, and information asymmetries. So state intervention can correct such failures. That is the first argument. The second argument is equity and distribution. Two, equity and distribution. Now, markets can create vast inequalities. So the state intervention can provide what we call social safety nets, ensuring basic needs are met and ensuring that resources are distributed more equitably. That's why there is the argument for the state intervention in economic activities. Developments, number 3. The next argument is based on developments. In less developed economies, state intervention may be necessary to build infrastructure to foster industrialization and protect infant industries. That is an argument for state intervention. Less developed economies may need state intervention for the purposes of protecting infant industries and also building infrastructure and fostering industrialization. The fourth argument, stability, is on stability. Governments can use fiscal and monetary policies to stabilize the economy, preventing economic busts, economic recessions, and so on. So these are 4 arguments for the state intervention. Let us now highlight the arguments for market-based solutions. Arguments for market-based solutions. What are the arguments for market-based solutions? The first argument is in regard to efficiency. Efficiency. Now, markets are generally considered to be more efficient at allocating resources than governments due to competition and price signals. So markets are considered to be more efficient when it comes to allocation of resources. Another factor here is innovation. Innovation has been used as an argument for market-based solutions. Competition in markets fosters innovation and technological advancements. That's why the proponents of the market-based solutions prefer that there should be minimal or no state intervention in economic activities. 3, freedom and choice is a third point. Markets allow for greater individual freedom and choice compared to centralized planning, and that is one solution to market-based. That is one way in which it can be argued that the market allows for greater individual freedom. It allows for freedom for individuals to choose the products they want. And when choosing the products they want, the resources can now be allocated depending on what people really need, as compared to having a central body that plans on what should be produced and how much should be consumed. Markets can regulate itself in terms of what should be consumed and what should be produced because of freedom and choice. 4, limited government. How is limited government an argument? Now, excessive government or excessive intervention by government can lead to bureaucracy, can lead to corruption, can lead to inefficiency. And that's why the proponents for market-based solutions argue that there ought to be limited government in economic activities. So these are 4 arguments for market-based solutions and 4 arguments for the state intervention. Now, there are different perspectives based on what we've just discussed, different perspectives. We are going to be brief on these perspectives. Just to summarize, candidates, there are different economic schools of thought that are varying on this debate. There are different schools of thought that have varying perspectives on the state market debate. The first school of thought is classical economics. 1, classical economics. Classical economics. Advocates for minimal government intervention believe that markets naturally self-regulate to achieve optimal outcomes. Now, the classical economics are basically what we call the laissez-faire. 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 The laissez-faire. That is the classical economics. Then we have the Keynesian economics. Keynesian economics. Keynesian economics supports a more active role for the state in managing the economy, especially during downturns through fiscal and monetary policy and so on. Keynesian economists argue for more active role of the state in managing the economy. Then we have the neoliberalism, the liberals, neoliberalism, the neoliberalism, the neoliberalism, the neoliberalism, all right? The neoliberalism emphasizes deregulation, privatization, emphasizes free trade. You understand? With limited role for the state in economic affairs. From the word liberal, neoliberalism. Neoliberalism. It argues for free trade, privatization, and minimal or no involvement of government in economic affairs. That is the third school of thought, or the third perspective on the state market debate. Then we have the developmental state school of thought. The developmental state is also a school of thought or a model that is often associated with the East Asian economies, and it involves strong state intervention to guide industrialization and economic growth. So that is the debate, candidates. These are arguments for the debate. These are arguments for market, arguments for the state intervention, arguments for the market-based solutions, and these are the four different schools of thought. But it's important for us to appreciate that in reality, most economies operate as mixed economies with a combination of state and market mechanisms. And the optimal balance between the two depends on various factors, including the nature of goods and services. Right? We are talking about balancing state and market. Balancing state and market. Balancing state and market. I've just said that in reality, most economies operate as mixed economies where there is a balance between the state intervention and market-based solutions. So the optimal balance depends on various factors. All right? So these are the factors. The first one is the nature of goods and services. One, nature of goods and services. The balancing of state and market solutions depends on various factors which include one, nature of goods and services. Some goods like national defense are inherently public and require state provision. All right, national defense, while others are better suited for market provision. Goods like bread, right? Services like education, products like electronics. Those are best suited, are better offered by the market. But there are some goods and services which are inherently public, like infrastructure, roads, street lighting. Those can be handled by the state. So do you understand? I've said that there is a balance between state and market, because in reality, economies have a mix, and the optimal balance or mix between state and market depends on various factors, one being the nature of goods or services. Then there is the level of economic development. Level of economic development. The level of economic development. Developing countries may require more state intervention to build, that is developing. The ones that are developing, like Kenya, may require more state intervention to build infrastructure, to build institutions, and so on. But the developed countries may not require much state intervention because they're already developed. They have the infrastructure, they have institutions, they have structures, they have politically developed, so they may not require much state intervention. Another factor is political and social context. Political and social context. Now, the political system and the social values of a country may influence the acceptable level of state involvement in the economy. We have those political systems that are highly democratic, others are socialistic, others are communist. So depending on the political system, all right, and the social values of a country, that could be a factor that will determine whether a country will have minimal or no state intervention in economic activities. 4. ETC. ETC means end of thinking capacity. So candidates, these are 3 factors that may influence or determine the level of government involvement in the market. Now, in the Kenyan context, Kenya has grappled with state market debate throughout its history, just like many developing countries. And after independence or post-independence, the government adopted a state-led development model with significant state involvement in the economy. But in the recent decades, there has been a shift towards market-oriented policies. And we've seen a lot of privatization and liberalization of various sectors. So the current approach in Kenya emphasizes a mixed economic model, with the state playing a role in providing essential public services, regulating markets, and also promoting social equity, while at the same time encouraging private sector participation in the economy. But it's also important to note that the state market debate is an ongoing process. It is ongoing, and there is no single universally accepted answer when it comes to the state market debate. And therefore, the most effective approach is often a pragmatic one that recognizes the strengths, recognizes the limitations of both the state and the market, and seeks to strike a balance between the state and the market. So that's all we can say as far as this debate is concerned. We began this lesson by defining the state market debate. We say that this is a debate that revolves around the appropriate level of government intervention in the economy. To what extent should the government get involved or intervene in the market or in the economy? We highlighted these 2 arguments on both sides: arguments for the state intervention, then we have arguments for market-based solutions. We've briefly described the different schools of thought: the classical economics, that is the laissez-faire, the Keynesian economics, neoliberalism, and developmental state. Then we've also stated that there is, in reality, there is a mix. Most countries have a mix or a balance of state and market engagement, And we say that there are various factors that determine the level of the state's intervention or involvement in the market. One is the nature of goods and services. We say that there are some goods and services that are inherently public, thereby forcing the government to provide such goods or services. We also mention the level of economic development. Depending on the level of economic development of a country, that will determine the degree of government's intervention in economic activities of a country, with the less developed countries having more government intervention as compared to those that are highly developed. There is also the aspect of political and social context. The political and social context are factors that will determine the level of government involvement in the market. Now, having said that, we bring this lesson to an end, but here is your today's assignment. 1. What are the key arguments for and against state intervention in the economy, and how do different economic schools of thought view this debate? 2. In what circumstances might state intervention be justified to address market failures or promote development? Provide specific examples. 3. What are the potential risks and drawbacks of excessive government intervention in the economy, and how can this be mitigated? 4. How can a country strike an optimal balance between state and market roles to achieve economic growth, social equity, and environmental sustainability? That's the end of the lesson. In our next session, we are going to study the typology of public enterprises. Bye.
Dear learner, welcome to the lesson today under the Manifested Publishers Learning Platform. And we are continuing with our human resource management subject. And we are looking at the lesson on reward management. And in reward management, we have an area on salary administration policy, which we are going to look at today. And when you look at a salary administration policy, it is a guideline that is used to determine, implement, and review salary levels and structures in an organization. So this is very critical because payment of salaries and rewards to workers need some format or some arrangement where decisions which are being made are made consistently in a transparent manner and can be verified. So a salary administration policy provides that guideline to be able to assist in the determination, implementation, and review of salary levels and structures in a structured way in a given entity. So in our lesson today, we are going to look at the importance of a salary administration policy. We will also look at components of a salary administration policy and the structure of a salary administration policy. So we will start with the importance of a salary administration policy. Importance of a salary administration policy. Salary administration policy. So why is we have seen that a salary administration policy is a guideline, and this guideline provides a direction in relation to determination, implementation, review, and looking at the levels of salaries in a given work environment. So when it comes to the importance, one of the reasons why a salary administration policy is important is to eliminate, so one, elimination of perceived salary inequalities. elimination of perceived salary inequalities. Oftentimes, Lana, workers have a feeling that maybe they are not being paid commensurate to their efforts. So when you have a guideline, then this guideline will eliminate this perception, and workers can be able to see what is their grade, where are they in the structure, how do they progress. So this becomes a guideline that can help in the elimination of the perception of salary inequalities among staff. Then secondly, it helps in the attraction, of talented workers. So when an organization has a structured salary arrangement or a policy, then prospective employees are able to look at this kind of a guideline, and if they have the wish to join that organization, this can be one of the reasons why those kind of employees can be attracted to that given work environment, so that they can be part of that kind of a workforce. Then number three, assists in the retention of employees in an organization. So employees who have their salaries determined, their salaries reviewed on the basis of a given policy or a given guideline, where individuals don't have to use their own maybe discretion, then such employees can be retained in a given organization to be able to perform their duties and be rewarded or compensated. Then there is the element of engagement levels are higher among staff, amongst employees. So employees in an organization that has a salary administration policy which guides in terms of, say, promotion, maybe lateral transfer, benefits and so on, those kind of employees will be engaged more in terms of their work, because they know other issues like, for example, reward management are assorted by this particular salary administration policy. So the engagement levels of staff are likely to be high. Then there is also the element of compliance with the legal obligations, compliance with the legal obligations. For example, if an organization is supposed to comply with the minimum wage, minimum salary levels. So this kind of an organization will ensure that their policy is very clear. Whenever there is even an adjustment in terms of the legal thresholds, the policy of implementation of salary has to pay above, at the minimum or above the minimum salary level. So that gives the employees who are making decisions the implementation authority to ensure that compliance with legal obligations as far as salary is concerned is enshrined in terms of that particular policy. And when it also comes to, for example, statutory returns, they are made in accordance with the salary administration policy within that particular work environment. So that compliance, again, is one of the reasons why having a salary administration policy is important. Then there is the element of financial management assists in financial management, especially with labor-related costs. So salary administration policy will assist in the financial management, and in many organizations the costs of payroll could take as much as, say, 45% of the organizational expenses. So you can see this can be quite high, and when you have a proper salary administration policy, it becomes very clear. Then number 7 helps the organization better negotiate with trade unions. So where an organization has a proper system in relation to administration of salary, then they are able to at least discuss with the union officials, discuss with trade unions, and be able to come to an understanding in relation to how reviews are supposed to be done. If there are any disputes and so on, they are able to negotiate based on the policy within a given organization. So those are some of the reasons why it is important for an organization to have a proper salary and administration policy in a given organization. Then we can have a look now at the components of a salary administration policy. Components of a salary administration policy. Components of a salary administration policy. So what are some of the aspects you expect to get, some of the contents you expect to see on a salary administration policy? So when it comes to a salary administration policy, some of the things that may be handled here may include 1, basic pay, 2, house allowance, 3, traveling allowance. Then you have 4, overtime pay. Then you have 5, leave allowance. Then you have 6, tuition assistance. So some organizations, Lana, have a tuition assistance option where if workers are taking up some course, those workers could be assisted by the management to be able to pay for that particular tuition. And in some cases, there are also some generous employers who are basically able to assist the spouse and maybe the children of the employee. So those could be some of the things that are captured in terms of components of a salary administration policy. Then you have 7, promotion. Then you have 8, transfer. Then you have 9, pension. Then you have 10, deductions. So these deductions could, for example, be for trade union or cooperative, or other checkoffs and so on. So these could be some of the things you expect to get on maybe a payroll in terms of the components. So basic pay, house allowance, traveling allowance, overtime pay, leave allowance, tuition assistance, promotion, transfer, pension, and maybe other retirement benefits, deductions, among others. So this could just be part of the things that may be addressed in relation to components on a salary administration policy. Now, for organizations that have a salary administration policy, they may have a document, and this document is what is referred to here, salary administration policy. So we want now to have a look at a structure of a salary administration policy. Structure of a salary administration policy. Structure of a salary administration policy. So the question is there one specific kind of a structure? The answer is no. Organizations may have different policies structured in certain ways. But some of the information that may be cross-cutting is what we want to have a look at. So that if you have a structure of a salary administration policy, or if you go to an organization, dear learner, or you work for an organization and you have now been told, prepare a salary administration policy. So what are some of the things that may be on that particular policy that you may want to include? So one, the name of the organization. So one, name of the organization. So that becomes at the top, or maybe this one can be a logo. So you may have a logo. So you have a logo showing that this is organization XYZ, this is the address and so on. So that will be at the top. Then number two, you may have the title of the policy. So an organization may now structure it according to their needs, and that title could, for example, be Salary Administration Policy. Another organization may have the title as Wage and Salary Administration Policy. So depending on the title that is selected, the title will indicate there. Then number three, scope of the policy. Scope of the policy. So in some organizations, they may say the scope of this policy covers administrative and management positions, or this policy covers lower level and middle level positions, for example. So the scope of the policy has to be indicated. And then number four, administration of the policy. So it has to be indicated who is administering the policy, who is administering that particular policy. So maybe it may indicate that this policy will be administered by the Human Resource Department or Human Resource Section. So administration of the policy has to be indicated so that if there are questions, those questions are directed to that particular department or section. And then description of the jobs are covered. So in this description, it may indicate that the jobs which are covered here could be human resource jobs, marketing jobs, and so on. So the description could be included. And then number six, grades or scales for jobs. That should also be indicated. And then there are those particular specific items now that will be covered in relation to that particular policy. For example, 7, entry into maybe jobs or grades. So that should be indicated. For example, if an employee is being recruited for the first time, what is the policy in terms of where this particular employee is supposed to enter? Then number 8, progression. So the policy has to provide, remember we said it's supposed to be a guideline. So the policy has to provide a guideline. When an employee is promoted from a position to the other one, what happens in terms of the progression? How do they enter into maybe the next scale? So that must also be provided as a guideline. Then number 9, transfer. So if an employee is being transferred, what should be the policy? You are being transferred from Nairobi, for example, to Mombasa, from Mombasa to Kisumu, from Eldoret to Nakuru. So if that transfer is taking place, in relation to salary, what happens? In some organizations, including government, for example, what happens is this: if it is the employer who is transferring you in terms of public service, the employee is transferred, yes, but that employee is given 2 months equivalent of salary in the month of transfer if the transfer has been effected by the employer. So that has to be provided for in terms of the salary administration. So if, let's say, the administrator of this policy is HR, on that month when an employee is transferred, if their salary is 35,000, then for that month they multiply this, they multiply that by 2, and pay that employee 70,000, and they refer to the policy that the policy provides if an employee is being transferred, the salary is paid double and so on. Then there are also issues of number 10, acting in position. So if an employee acts in a position for a given duration of time, so when that employee is acting and they are also performing their own work, for example, so what happens? That must be provided for in terms of the salary and so on. Then number 11, there is the issue of maybe incentives and bonus. So if incentives are supposed to be provided, this particular structure policy, this particular salary and administration policy must provide in terms of the incentive and bonus who is entitled to these particular incentives and bonus and what is supposed to be the formula to be used. So that is also important to ensure that workers don't complain. Then you also have issues of basic pay. Basic pay, that must also be indicated that if the basic pay is supposed to be paid, when is it supposed to be paid, when is it supposed to stop in terms of, let's say, when the worker is retirement and so on, retiring. Then you have issues to do with pension and benefits. So that again must be provided for in terms of this particular salary and administration of wages, for example. So when it comes to pension, if it is a contributory pension, deductions have to be done. For example, if it's non-contributory, that information has to be provided for. Okay. Then when it comes to issues like now retirement, that must also be provided. There are also issues to do with the leave, and this leave can be in many ways. You can have, for example, annual leave. You may have, for example, leave of absence. So when an employee is on leave of absence, what happens? Do they get paid? If they are on annual leave, what happens? Do they get a leave allowance, or do they get their full maybe gross salary and so on? So this could be some of the things that could be found on a salary, on the structure of a salary and administration policy. And in addition to this, the structure of a salary must also have maybe authorizing officer, and in most cases, in many organizations, that is the CEO, and then this must be dated. Okay, so that particular policy must have the authorizing officer, who could be, for example, the CEO, and that CEO has to sign that particular document and date it, and maybe indicate when will that particular, for example, policy be reviewed. So that is as far as the structure of salary administration policy is concerned. This could be some of the things that could be contained there, including now these other components we have also mentioned here. So dear learner, in our lesson today, we have looked at salary administration policy, and we have indicated that a salary administration policy is a guideline that is used to determine, implement, and review salary levels and structures in an organization. And we indicated that we would look at 3 areas, which is importance of a salary administration policy, components of a salary administration policy, structure of a salary administration policy. And under importance of a salary administration policy, we have said, number 1, it helps in the elimination of perception of salary inequalities. Number 2, helps in the attraction of talented workers. Number 3, assists in the retention of employees in an organization. Number 4, enhances engagement levels of employees. Number 5, assists in legal compliance, for example, minimum wage or salary. Number 6, assists in financial management, especially relating to labor issues. Number 7, helps the organization to better negotiate with trade unions. So learner, Those ones are just some of the reasons why a salary administration policy in an organization is important. Then we went ahead and looked at the components of a salary administration policy, or the contents. Now, a salary administration policy should capture basic pay, number one. Number two, house allowance. Number three, traveling allowance. Number four, overtime pay. Number five, traveling allowance, leave allowance. Number six, training assistance or tuition assistance. Number seven, promotion. Number eight, transfer. Number nine, pension. And number 10, deduction. So learner, again, these ones are some of the components. The organization doesn't have to have all of them. An organization may capture the ones which are relevant to their needs. So the components of a salary administration policy, we have said that you may have a chance to be able to maybe formulate a policy. So this is just a guideline, and this is what you may find in one organization. There are also things that might not be covered here that could also be captured on the salary administration policy for a given organization. Then we went ahead, learner, and looked at the structure of a salary administration policy. So how can it be structured? Then we said, number one, it needs to have the name of an organization and, if possible, the logo, the title of the policy, which captures the specifics of that particular organization, the scope of the policy, number two, number three, number four, administration of the policy, where is it hosted, number five, description of the jobs that are covered, number six, grades or scales for jobs, number seven, entry into jobs or grades, number eight, promotion progression, number nine, transfer, number 10, acting in position. So if an employee is acting in a given position, what should be the payment like? Number 11, incentives and bonus. Number 12, basic pay. 13, pension and benefits. 14, retirement. 15, leave, which may, for example, be annual leave, leave of absence. In some organizations, there are also other types of leaves like study leave. Then you have authorizing officer, who is the CEO, dates that particular policy, signs and indicates when that particular policy will be, for example, reviewed. So, Lana, we have looked at salary administration policy under reward management in our lesson today. And before we finish, I want to leave you with an assignment. And your assignment for today, dear learner, your assignment is discuss the benefits that may be enjoyed. Discuss the benefits that may be enjoyed by an organization that formulates and implements a salary administration policy. So, learner, this is your assignment. Discuss the benefits that may be enjoyed by an organization that formulates and implements a salary administration policy. So that's your assignment that you need to work on to be able to entrench the knowledge that we have gotten today, and also enhance your skill in the area of salary administration in our topic that we have looked at today, which is human resource management, and in the practice of human resource management. So thank you.
Greetings, candidates, and welcome to the program. Today we are going to start on a new chapter, which is known as Information Technology and Communication. The subject is communication skills. This chapter has 5 sections. Number 1 is the role and impact of technology in communication. Number 2, communication networks. Under communication networks, we will study internet, intranet, and extranet. Number 3, teleconferencing and video conferencing. Number 5, webinar. Then lastly, wireless technology. Wireless technology. So we're going to take a subtopic one at a time. Today we begin with the role and impact of technology in communication. Now, candidates, although people refer to the present time as the age of information or age of communication, communication has been important in whatever age people have lived. There is always been need to communicate or to convey messages from one person to another or from one organization to another. The big difference between communicating in our age and communication in the earlier centuries is that we have the means to convey vast quantities of information at greater speed. And it's important to be aware that this is what computers have enabled us to do today. In other words, computers are tools that allow us to communicate much more efficiently than in the past. Today we are examining the role and the impact of technology in communication. And by now, I know you are aware that information and communication technology or technologies, is, when we say ICT, we are referring to an umbrella term that includes any communication device or applications encompassing the radio, the systems, television, satellite systems, as well as the various services and applications associated with the devices that I've mentioned, such as video conferencing, teleconferencing, webinars, and so on. So we are examining the role and impact of technology in communication. Let's first take the role. What is the role of technology in communication? Now, the first point here is that technology has led to increased capabilities in communication. Increased capabilities in communication. Increased capabilities in communication. Now, candidates, I can say that business productivity has increased dramatically with the mobile communication tools and has also made it possible to work from anywhere, to work anytime, and so forth. So with instant messaging, the capabilities of communication has become even more powerful. We have regular instant messaging. Through regular instant messaging, users have increased the number of people they contact and the frequency of such contacts or communication. While there has been a decrease in the number of other areas of communication. So technology has led to increased capabilities in communication. The second role, technology has led to building of customer and partner relationships. Technology has led to building of customer and partner relationships. Partners like, say, clients, business partners, get instant access to the company's contacts, instant access, right when they need them, and therefore there is no time that is wasted. Through technology, information moves very fast from the company to the customer, or from suppliers to the company. There is fast movement of information, thereby leading to building of good relationship between business partners. 3, technology has led to increase in employee productivity. Technology has led to increase in productivity of employees, since there is what we call on-the-spot responses. On-the-spot responses. Employees can respond on the spot, and therefore work can be done faster and more efficiently. Employees today can leverage on technology to increase their productivity. That, candidates, is self-explanatory. Technology can be relied upon to increase productivity of employees. The 4th role of technology in communication is the ability to hold one-on-one conferences. One-on-one conferences. In this chapter, we'll be studying video conferencing, we'll be studying teleconferencing, we'll be studying webinars, and so on. We'll be studying virtual meetings, and so on. So, through technology, employees can be able to have one-on-one conferences online without necessarily having to meet physically. Employees are able to hold virtual meetings without having to move from one location to the other. So wherever an individual is, a company can hold meetings, can hold conferences, can hold seminars, courtesy of technology. Another role of technology in communication, number 5, we can say, is that technology offers opportunities for online marketing and online business transactions. Online marketing and also online business opportunities. Before the advent of technology or the internet, marketing was basically done physically. Today you can reach many people in an instant because of technology. Is able to reach many people when seated in your office. You can flaunt your products online so that people can see the products in an instant. Millions can access the products. Before the advent of technology, it's not possible to do that. You have to maybe do physical marketing, face-to-face marketing, and so on. So here, candidates, employees and customers can deals on the spot while online. So there are many roles, candidates, of technology in communication. All right. Let's now discuss some of the impacts of technology, impact of technology in communication. Impact of technology on communication. The first one is speed. Speed. And related to speed, we have cost. Speed and cost. Now, the introduction of internet and the option of, say, chatting and sending emails are probably the most noteworthy influences of technology on communication. In the days before, in the days that preceded the advancement of technology, it was not easy to reproduce or even produce a document because it required typing and retyping. Today, a document can be reproduced in an instant and also be sent in an instant. The internet and computers have simplified the process of designing, editing, producing documents with the minimum shortcomings. And the created documents can then be sent to the respective recipients almost instantly. Almost instantly, irrespective of the distance or location between the sender and the recipient. Now, candidates, in a nutshell, I'm saying that technology has greatly improved the speed of communication as well as contributing to the drastic reduction of communicating costs. That's the first impact of technology in communication. Number two, quality. Quality. Now, communication quality, candidate, has significantly improved due to the availability and accessibility of helpful knowledge in various websites. And technology has enhanced storage as well as recovery of communication when the need arises, chiefly the verbal communication, whose storage post real challenges in the pre-technological era. Candidates, it has now become quite easy to clear doubts or misconceptions by contacting all parties who are involved in communication. Today we have minimal misunderstandings because of the quality or the improvement in the quality of information, and that is courtesy of technology. Number three, accessibility. Accessibility. That's another impact that technology has had in communication. Technology has considerably diminished communication cost, and this has translated to increased accessibility. The media that is related to initiatives as news, for example, that has been captured live, and online forums have introduced global participation and access to information and news for lots of people. Furthermore, candidates, access to privileged information is also an advantage. We have had people accessing what we normally is referred to as privileged information, especially in the business realm. And that has led to companies crafting what we call competitive advantage and a holistic success of organizations. And technology has played a central role in promoting widespread access to knowledge and information. Previously, it was not easy to access certain information, but because of technology, many companies have been able to access information and therefore crafting some sort of competitive advantage. Technology has also had an impact on the nature of communication. Nature of communication. Nature of communication. Technology has contributed to the alteration of topics into different communications as people seek to pass on, say, news or information within the shortest time possible. We've seen advancement in technology which has simplified communication, allowing voluminous messages to be sent at minimum cost. And in this respect, candidates, people can now change the nature of information to adopt to the form that they will easily comprehend. 5, candidates have just been discussing positive impacts of technology on communication. We all know that there has also been some negative impact of technology in communication. I'll discuss one here. That is the impact of technology on communication in respect to non-verbal communication. Okay? Non-verbal communication. Non-verbal, the effect on non-verbal communication. Now, technology is candidate means that we can say technology has affected non-verbal communication because in many instances there is lack of face-to-face interaction. And we know the benefits of non-verbal communication. It's sometimes not easy to people to interact face-to-face. We know face-to-face has its own advantages which cannot be replaced by technology. So that is a negative impact of technology in communication. Body language. It's not easy to read someone's body language when communicating on the phone or on email. All right, so these are some of the impacts of technology in communication. We've also discussed the role of technology in communication. We've said that technology has led to increased capabilities in communication. Technology has also led to building of customer and partner relationships. Technology has led to increase in employee productivity. Number 4, one-on-one conferences, courtesy of technology. People can have one-on-one conferences like webinars, video conferencing, teleconferencing, and so on. Another role is in respect to marketing and online business opportunities. Then on impact of technology, we've discussed the impact of technology in relation to speed and cost. Quality of communication has also been affected by technology. Through technology, there is also an effect of accessibility of information and data. We've said that technology has considerably diminished communication cost, and it has made it possible for many people to access data that previously was not accessible. The nature of communication has also been affected due to technology. And lastly, there is a negative impact here of technology on communication, especially nonverbal communication. Thank you for attending today's session. I'm going to give you one question or two questions here for your assignment. Discuss the impact of technology in communication. When answering the question, please make sure that you don't refer to the notes. Try and see if you can recall what we've learned in today's lesson. Thank you. God bless you. Bye-bye.
Dear learner, welcome to our human resource management subject. Today we are looking at performance-related pay, which is a subtopic in the reward management area of human resource management. And performance-related pay, as is used in human resource management, performance-related pay scheme is a remuneration system where reward to an employee depends on the performance of an employee, and the performance of the organization. So you can see, dear learner, there are two things. Performance-related pay is dependent on how the employee performs and how the organization performs. And that's why the issue of relationship comes in. So performance-related pay. So the pay is at two performance levels. The employee is expected to perform at a particular level, and the organization itself is also supposed to have performed at a particular level for this to be effective. Now, there are four main features of performance-related pay, and these four main features are the basis of the scheme, consolidated pay increases, variable pay, and pay progression. So when it comes to the basis of the scheme, in relation to performance-related pay, the basis of the scheme must be defined, and the basis of the scheme may, for example, be maybe organizational performance, So the way the organization performs may be the basis of the scheme, so that you look at the overall organization performance, and then the performance-related pay could be determined. Maybe you may want to look at it in terms of maybe a bonus, and the bonuses could be, for example, of various types. So the basis of the scheme may be organizational performance, which may be affected now in terms of the bonus or bonuses to be paid. Then when it comes to the consolidated pay increases, maybe the pay may be increased, pay may be adjusted, pay may be adjusted based on particular parameters that they may, for example, come in, and it will be in a consolidated way, so that a particular specified amount may be the total amount that is given as an increase, as a pay increase, and that may be given maybe at one point in time or over a period of time. And then when it comes to variable pay, the way the word suggests, this may vary and may be paid one-off payment. So let us say in the month of the end of December of a given year, an employee or a group of employees have performed and are supposed to be provided with a variable pay. Then for that particular end of year, maybe December or January, those particular employees, their pay is varied and then readjusted. Or maybe it is varied at one time, and then it's a one-off adjustment, and that becomes the variable pay, which is a feature of performance-related pay. Then there could also be pay progression, determined. This could be determined for a given period. So you may, for example, say there will be pay progression maybe at the end of 1 year, say maybe in the month of July or in the month of January, the pay progression will take place, and it will be progressing maybe at a particular percentage, maybe at say 5% of the prevailing, for example, scale and so on. So that again could become pay progression as a feature of performance-related pay. So these are some of the main features of performance-related pay that we have indicated. Looks at specifically the performance of the individual and the performance of the organization. So what could be some of the suitable conditions for performance-related pay? Suitable conditions for performance-related pay. Suitable conditions for performance-related pay. And by this, dear learner, what we mean, what features should prevail on the ground, or what circumstances should prevail in an organization to make it suitable for an organization to operate a performance-related pay system. So one, an organization should have an entrepreneurial culture. An organization should have an entrepreneurial culture. So where employees are entrepreneurial, then these employees can invest their ideas, can invest their innovation, and that one can lead to better performance of the workers and the organization. So there should be a practice of employee involvement in decision making. So for you to have a successful performance-related pay system, then workers in that particular organization should have gone through a practice of being involved in the decision-making process, so that they can participate fully in ensuring that they can be able to bring in the aspect of performance-related pay in terms of agreeing on objectives. And then number 3, transparency in salary and wage, or what you are calling reward management matters. There should be transparency in salary and wage or reward management matters, so that workers can be able to have confidence in this particular system. Then 4, clear objectives of performance. A clear objective of performance must be in that particular environment, so that it is very clear in terms of what is expected, in terms of the management and so on, in terms of the workers. So that could be very, very clear. Then number 5, supervisors and managers should be well versed and skilled in managing performance. Then there should be a clear communication channel in the organization. And then number 7, full support of the top management regarding performance related pay. So what you are saying, Lana, there should be full support of the top management regarding performance related pay. Is it? And then number 8, payments should be made when they are due to gain the confidence of employees in the system. So Lana, workers will give the system a benefit of the doubt, and they will want to see one cycle. So if they agree on what is supposed to be paid, they produce on their part and so on, the organization gains, so the workers will be waiting to see, will the management make that particular commitment in terms of payment? So if those payments are made, then workers can support the system. So these are some of the factors that should be suitable conditions for performance-related pay to succeed within a given organization. So today, Lana, we have looked at the performance-related pay area of reward management, and we have listed some of the suitable conditions. We have also looked at the main features, and we can very quickly revise what we have done today. And we have said that performance-related pay scheme is a remuneration system where reward to an employee depends on the performance of an employee and the performance of an organization. And the main features of performance-related pay are 1, the basis of the scheme, then 2, consolidated pay increases, then 3, variable pay, then 4, pay progression. And we have also indicated and discussed that when it comes to performance-related pay, for it to be able to succeed, dear learner, there are certain conditions that should be suitable, or an environment that will be suitable for the success of performance-related pay system. And we are saying that number 1, an organization should have an entrepreneurial culture. Then 2, there should be a practice of employee involvement in decision making. Then number 3, there should be transparency in salary and wage or reward management matters. Number 4, clear objectives of performance should be set out. Number 5, supervisors and managers should be well versed and skilled in managing performance. Number 6, there should be a clear communication channel in the organization. Number 7, full support of the top management regarding performance-related pay. And number 8, payments should be made when they are due to gain the confidence of employees in the system of performance-related pay. So, dear learner, those are some of the suitable conditions under which performance-related pay system can be able to be operated objectively and successfully. So before we terminate our lesson today, you have an assignment. Your assignment for today, examine the conditions, that may make the performance related pay system succeed in a workplace. So dear learner, your assignment, examine the conditions that may make the performance-related pay system succeed in a workplace. So that's your assignment, and until our next lesson, bye-bye. Welcome learner to our lesson today. We are looking at the human resource management subject, and this is under the manifested publishers learning platform. And in today's lesson, we are looking at reward management, and under this we are looking at two areas, pay structures and wage systems. We are going to start with pay structures, then we proceed to pay structures, then we proceed to wage systems. So dear learner, pay structures in reward management do several things. So one, they provide a framework for managing pay. Pay structures will provide a framework in terms of entry point, progression in relation to the workers. Then number two, pay structures contain the organizations, the pay ranges or scales for jobs grouped into grades, maybe grouped into grades, into bands, or job family level. So it depends on which one an organization has selected. Then three, pay structures define the different levels of pay for job groups or groups of jobs by reference to their relative internal value. So this relative internal value is usually defined by the process of job evaluation. And this is done in consideration of the external relativities of this particular job, so that the value of that job is determined and the worth is determined within the job hierarchy within that particular organization. And then pay structures also provide the scope for pay progression in accordance with the performance, competence, contribution, or service. And what this fourth point here helps an organization to do, you may have two different employees. And these two different employees, though they may have been employed at the same time and they're in the same grade, but their progression now will depend on the performance these particular employees have given to the organization, their competence. One of the employees might, for example, have gone through training, has gotten on-the-job experience, and that particular employee is contributing more, and that employee has made, for example, 5 years or 6 years of service to that particular organization. So when you take into consideration performance, competence, contribution, or the length of service, then that one can help an organization to determine what would be the progression level of a given employee or a set of employees in a given organization. So that is as far as the pay structures are concerned in terms of what they provide in relation to human resource management. So what are some of the guiding principles for pay structures when an organization is providing a pay structure? So what are some of the things that they should look at? So pay structures, dear learner, pay structures, what should be the guiding principles in terms of pay structures? So pay structures should be appropriate. So one, should be appropriate to a culture in an entity. Now, for example, if you are dealing with, say, public service, then the kind of pay structure that should be adopted should be an appropriate pay structure that can take into consideration the culture. And as you have noticed within the civil service ranks, what happens is that employees work for long durations of time, and in most cases they look at the aspect of seniority. So if you are looking at the aspect of seniority, and the culture is that employees need to have loyalty and commitment, then the appropriate pay structure that should be, for example, adopted in the public service should take into consideration issues of performance, issues of seniority, and issues of length of service, so that becomes appropriate to that kind of setting. Then secondly, should facilitate a pay structure learner should facilitate achievement of transparency, should also facilitate the achievement of equity, should also facilitate the aspect of consistency in salary administration. So what we are saying, if you are looking at the pay structure, then that particular pay structure that is adopted by an organization, a guiding principle should be that this pay structure should facilitate equity, should facilitate transparency, should facilitate consistency in salary administration, so that it helps an organization to display the characteristics of a good reward management strategy within a particular organization. Then next, a pay structure should be flexible to respond to changes, e.g. skill acquisition, seniority. So basically you are saying you have a pay structure, and if employees, for example, acquire some skill, if employees, for example, attain a level of security, let's say, for example, 12 years of experience, for example. So if you have 3 workers, then this particular structure should provide that this employee who has been in an organization for 12 years could be moving maybe on an annual progression in terms of, say, 3 years, or maybe annual increments and so on. So that becomes a very useful principle in relation to designing pay structures within a given organization. Then it should also facilitate another guiding principle. A pay structure should facilitate ease of administration. Take, for example, learner, if an employee has been in one lower, for example, grade and is moving to another grade, so the pay structure should be made in such a way that they could be overlapping, so that that transition becomes smooth and an employee is able to be adjusted in terms of that particular next grade. Then should also facilitate management control of pay. So the system should be good enough so that an organization should facilitate management control of pay issues, so that in case an employee has a complaint, it is possible to be able to look at the pay structure and articulate issues in relation to how this particular pay structure is supposed to be implemented. So that again becomes one of the guiding principles, and it should also be capable of responding to market pressure. Now, what this means is that an organization does its pay structures in the context of, say, a labor market. So in this labor market, there could also be, for example, changes. Let us take an example. Government may provide for minimum pay. So if the government is providing for minimum pay, the pay scales that are being provided, or maybe the pay structures that are being provided, should be able to accommodate the labor market changes, like the minimum pay that are mandatory, so that it pays above that minimum pay, to avoid challenges that could come from the legal perspective, where organizations are not able to explain. Then should also encourage career growth and development. So, dear learner, what this does, if you look at many systems within working environments, at the lower level, the pay structures would look like they have got lesser, for example, rewards, or maybe less pay. But as people move up the ladder, then that particular growth enables those who remain in that particular organization to grow in terms of their careers and to develop to better, for example, emoluments within that particular organizational setting. And that's why one of the guiding principles of a pay structure should be to encourage individuals to make an effort so that they can grow in their careers and be able to advance. So these, dear learner, are some of the guiding principles that should be taken into consideration when designing pay structures within a given organizational setting. Then these pay structures, once you have looked into these, say, guiding principles, it is important to note that there are different types of pay structures that organizations may make use of. Types of pay structures. We can mention types of pay structures. Now, the types of pay structures may vary, and an organization may use specific ones or maybe a combination. And the first type is what is referred to as the narrow graded pay structure. Narrow graded pay structure. Narrow graded pay structure. Narrow graded pay structure. So the narrow graded pay structure is a type of pay structure. And then you have the broad graded pay structure. Broad graded pay structure. Broad graded pay structure. So that is also a different type of pay structure that an organization can make use of. And then you have broad banded pay structure. Broad banded pay structure. Broad banded pay structure. So that is number 3. And then number 4, apart from those 3 structures, you have a career family pay structure. Career family pay structure. Career family pay structure. So you have a career family pay structure, and from that another organization can maybe be able to use that. Then you have a job family. Job family pay structure. And then you have number 6, spine pay structure. So these ones are examples of types of pay structures that an organization may have. So you have the narrow graded pay structure, you have the broad graded pay structure, you have the broad banded pay structure, career family pay structure, job family pay structure, and spine pay structure that an organization can be able to also use in relation to the kind of pay structures that organizations may design or may formulate for purposes of payment of workers. So, dear learner, in today's lesson, we have looked at the reward management topic, and in that topic we have looked at the area of pay structures and wage systems, and initially we have now looked at what are pay structures in terms of what they provide, and we have indicated that number one, pay structures provide a framework for managing pay. Number two, contain the organization's pay ranges or scales for jobs grouped into grades, bands, job family levels. Number three, pay structures define the different levels of pay for jobs or groups of jobs by reference to their relative internal value as determined by a job evaluation to external relativities. Number four, pay structures provide scope for pay progression in accordance with performance, how the employees perform, competence, contribution, or service. Then we have also looked at now the guiding principles for pay structures, and we have indicated, dear learner, that pay structures, number one, should be appropriate to the culture in an entity or an organization. Number two, pay structures should facilitate achievement of equity, consistency, transparency in salary administration. Then number three, pay structures should be flexible to respond to changes, for example, in skill acquisition, seniority, for example. Number four, pay structures should facilitate pay structures should facilitate ease of administration of the pay systems. Number four. Number five, pay structures should facilitate management control of pay. And then number six, pay structures should be capable of responding to market pressure. For example, the labor market minimum wage, that is minimum pay that is provided by government. And number seven, learner, pay structures should encourage career growth and development. So those ones are seven guiding principles for pay structures. Then we have gone ahead, learner, and looked at types of pay structures where we have indicated that there could be narrow graded pay structures, or number one, narrow graded pay structure. Number two, broad graded pay structure. Number three, broad banded pay structure. Number four, career family pay structure. Number five, job family pay structure. Number six, spine pay structure that organizations may use maybe independently or in combination. So your assignment for the lesson today, dear learner, assignment, you have your assignment. Describe your assignment, describe the guiding principles for formulating pay structures. So the assignment, dear learner, your assignment for today's lesson, which was pay structures and wage systems, describe the guiding principles for formulating pay structures. So that is your assignment, dear learner, and thank you for being attentive and participating in our lesson today.
Welcome, candidates, to the study of the subject leadership and management. The topic is leadership and strategic change. In today's session, we're going to study the levers for strategic change. Levers for strategic change, that will be our today's lesson. Now, candidates, the forces that act to embed and protect the current ways of doing things might also provide the basis for change. And levers are just the elements of change and its landscape that can be activated in some way to enable or support adoption on a broad scale. And leverage is where a small amount of effort, where a small amount of effort targeted in the right place at the right time, all right, can bring a big impact on the outcome. Leverage. And candidates, change managers alone cannot identify and deal with every individual's barriers to adopting change. But by identifying and applying the right levers, the change managers kicks off ways of mutually supporting self-perpetuating activities that can enable to create and maintain effect on a large number of people over a long period of time. So what are some of these levers for strategic change? I've defined leverage as a situation where a small amount of effort that is targeted in the right place can bring a big impact. So what are some of the possible change levers? The first one include, number one, the first possible change lever is a compelling case for change. Compelling case for change. Compelling case for change. Now, whichever management style that is adopted, candidates, whichever style that is adopted in the process of initiating change, there has to be a convincing case for change. The change managers must convince the change implementers of the need for change. And too often, the case for change is made in terms of the top-level managers' perception. In most cases, the change managers only consider the welfare or the interests of the top-level managers, most often. Most managers and employees, if you are to ask them, employees, you may find that they are not brought into the loop. So the change managers may in most cases consider the welfare of the top level managers or the welfare of the shareholders, but not the interests of the employees. That is, for example, meeting the expectations of shareholders or beating competition and so on. And when most managers and employees are asked what motivates them, on the other hand, there are many more factors that motivate them, including the impact of the change on the society, the impact of the change on the customers, the local working environment, the local working team, or even employees' personal well-being. Employees may be motivated due to their own welfare or welfare or their well-being, personal well-being. So when initiating change, is important that the change managers do not just consider the welfare of the top level of management or the welfare of the shareholders or just beating competition, but there has to be a compelling case for change which should also include the interests of the employees, because it's the employees who are to be relied upon on implementing change. There has to be a compelling change, a compelling case for change needs that speaks to different bases of motivation, and not just top-level managers' perceptions of change needs. So a compelling case for change is a lever for strategic change, where all the stakeholders are compelled for the need for change. Then, though being a small effort, that compelling case for change can set in motion waves that can roll towards the fulfillment or the success of change. Compelling case for change is a lever for strategic change. The second lever, number 2, changing operational processes and routines. Changing operational processes and routines can also be a lever for strategic change. Now, candidates, in the end, strategies are delivered through the day-to-day processes and routines of the operations of the organization. And that can be formalized and codified, or they might be less formal, maybe a less formal way of doing things, which is just a culture. And such routines can be the basis or the core competencies